The big issue here is, does the Fed get the kind of controlled moderation in labor markets and growth?
We just haven't seen that rise in the unemployment just yet.
We are starting to see some companies rip off the earnings Band-Aid.
Markups are insanely high everywhere. People have been gouging prices for any goods.
I think what's breaking is the soaring dollar.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
This is the 10th edition of Peak Bond Yields, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. TK, how many times have we done this? We're doing it again.
We're doing it again in June, and of course we see it, the Dow up 1,200 points or whatever, and you see it, they're leading the way maybe, and the NASDAQ coming up too. But John, I've got to go around the globe from Sydney to Perth this morning. Shock. And how do you link in this bond rally you're talking about with the shock from the Bank of Australia?
They go 25 basis
they
points
blink
instead of 50. Is that a blink?
That's a blink.
That
That's an official blink.
That's not a blink. That's just basically saying that perhaps we're closer to peak yields, right? I mean, that's basically, is that a blink? Does that count as a blink, maybe?
They blinked in Perth. They did not blink in Sydney.
Okay, but here's the question. Does this symbolize that central bankers around the world are hitting the thresholds for how much they can tighten policy in the face of financial stability risks, even as all that Fed speak, which I ignored yesterday, but still was there, basically came out and said, we're not going to blink. We're going to keep going. We have considerably more to go before we get to a tighter policy.
Well, let's go through the numbers and talk about where we are now relative to where we were a week ago. The 2-year was 4.35 last Monday. Right now it's about 4%. The 10-year was a little north of 4% last Wednesday. Right now the 10-year is 3.58. So you fold that into this discussion about the RBA, and you've got this broader story that we've seen peak bond yields. Again, we've done this about 5 different times this year.
We are data dependent into the fourth quarter in every way, shape, or form, including earnings, I believe, October 14th. But, John, mostly what we are is data dependent out to Friday.
So I would pick up on the data point as well. Let's say we have seen peak bond yields. Is that bullish? Is that bullish if we've seen peak bond yields and the weak data is still in our future, the weak earnings is still just around the corner?
Mike Wilson says no. Mohamed El-Arian says no. Many people say no, which is the reason why people are watching this story play out again of the pivot, the imminent pivot that has to happen from the Fed, that has to happen from the ECB. Take a look at European bond yields. Wow, they absolutely crashed yesterday. And people are saying, you guys are ridiculous. This is not what they're going to do.
Can we pick up on sterling just briefly?
Please.
6 days of sterling strength.
You always want to do sterling.
103.50 last Monday. 114 this morning. I think it's worth picking up given the weakness we saw last week.
You brought props yesterday. Come on.
I know. You brought a flat cap.
I know. So you want to talk about sterling just as much as anyone else.
Yes, that's true. But I would say John's right about the move. John, I've never seen anything like what we're seeing from the daring two of the trust government.
It's unreal.
Honestly, I'm like everybody else. I'm on my phone. To be honest, I go to the Telegraph and to Bloomberg's great coverage, and I go, you got to be kidding me.
There's now a conversation about maybe moving the budget forward and moving
from
it
November, whatever.
Moving it in so it's before the Bank of England rate decision. I mean, that would be the logical decision here, to allow the Bank of England to come up with some accurate forecasts relative to what they've heard from the fiscal side of things.
The problem is, how did they bungle this so bad?
Sure.
Why did they rush this out if they knew that there was going to be some pushback? And isn't this basically just a comment to, we messed up, but we're not going to say we messed up, and it really reduces the confidence in this administration.
Have we got some time for Ray Dalio a little bit later?
Yeah.
The cash is no longer trash.
It's not. Yeah.
We're seeing capitulation across the board here, aren't we?
Board. Well, do you consider that Marko Kalanovic capitulation as well?
I mean, for Marko, I think so. It was about that close to just saying I was wrong. You're going to say my price targets are at risk of being achieved in 2023, then they're no longer your price targets, are they?
I would look at Swiss franc as a real litmus paper, this entire debate. Seriously, from Australia to Washington, from what's the capital of Australia, Perth?
No, Tom. I'm pretty sure it's Canberra.
Canberra. Is that how you pronounce it?
I think so.
Canberra to Washington. It's all the same. It's all the same. It's just about the data. And it's a fascinating debate, a la what Mr. Dalio said. We'll talk
Australians will love us this morning, that's for sure.
They do. I'm nailing it.
I'll whip through the price action for you on the S&P 500. Futures are positive after a big day of gains yesterday on the S&P. This morning, up by 1.6%. We're positive 59 points. Yields lower by 6 basis points, 3.58 on a 10-year. As I said last week on a 10-year, a little north of 4%, Tom. We've come all the way back down.
And what I look at as a real yield, the inflation is just, look for the program, folks, on Friday. It comes in from a 1.60 to 1.38, a lower inflation-adjusted yield. And, John, you do that with the Bloomberg Financial Conditions Index improving today. It's less restrictive.
A dollar weakness at the epicenter of that, I would argue, Tom. 5 straight days of dollar weakness. Euro dollar, Lisa, 98.82.
Yeah, right now we're also looking at a whole host of Fed speak. We didn't do it yesterday. Today it's going to matter quite a bit. We've got Fed speakers, including Dallas Fed President Lori Logan and New York Fed President John Williams at 9 a.m. I just want to point out, John Williams spoke yesterday, basically coming out saying, we're not going to pivot, guys. Stop it. Just stop it. And the market said, haha, just kidding. So we'll see whether he reiterates that today. Cleveland Fed President Loretta Mester at 9:15, Fed Governor Philip Jefferson at 11:45 a.m., and San Francisco Fed President Mary Daly at 1 p.m. Yesterday, we saw the biggest one-day decline in 10-year Treasury real yields going back to March of 2020. There was a complete reset because people are not buying what these officials are saying, which is that they can still need to raise rates considerably, and they are going to stay the course until they see material change in the labor market, among other things. Talking of the labor market, 10 a.m., we get U.S. August JOLTS job openings data. This is key. Arguably, watch the data, Tom, you're saying? This is what I'm watching because you're looking for some sort of loosening up in the labor market, which we haven't really seen. I mean, yesterday, or the last time that we got job openings data, we actually saw an increase, not decrease. Companies were advertising for more people, raising questions about whether the labor market has fundamentally changed and companies are going to hang on to their workers for longer because of what happened during the pandemic and because of the worker shortage that they still actually do face. And at 11 a.m., we hear from ECB President Christine Lagarde. She's going to speak alongside President of the European Central Bank to Cyprus ahead of a European Central Bank meeting over the next couple of days. How much they address this belief in a pivot? Do they come out and they say, look, we still have considerably more to go. We're going to keep raising rates. Oh, and by the way, we see the chance of recession as more likely. John, how much is that projection of a no recession scenario as a base case for Europe part of what's giving people confidence in this pivot story? Because if they're not recognizing reality, then they're not weighing the political ramifications of hiking into more dramatic weakness.
Elisa, thank you. I think the ECB is the only group out there right now not forecasting a recession in the Eurozone.
Seriously.
TK, pretty much everyone else is forecasting exactly that, recession in Europe.
I do want to go back to this as Europe is the focal point. The war is in Europe. Lagarde, all of the institutions there have to face this. We underestimate, particularly off the furor yesterday of the Jeff Sachs interview, we underestimate the emotion right now of this.
Let's get to the market conversation with Ben Laidler, global market strategist at eToro. Ben, in your work, we see some hope this bond rout may be easing. This is a key ingredient for any equity recovery. Before we get to talking about whether this is positive or not for risk assets, can you tell me why you think bond yields may well be peaking this time?
I think it's difficult to see real yields just continuing to head to the moon at a time when all your inflation lead indicators are rolling over, where recession risks are spiking. I think the disconnect is in there, and I think given where real and nominal yields got to, and on the flip side, given where valuations and sentiment have got to, I think that risk-reward setup is very, very interesting.
Ben, given that, if the Fed is going to retrace some of its pretty hawkish statements, what does that mean in terms of earnings? We've heard this from Mike Wilson. We've heard this from Mohamed El-Erian, that be careful what you wish for, because if the Fed does retrace, that means that things are really bad and we have not priced that in.
I think this is, to your earlier comment, this feels a little bit like Groundhog Day, right? I think the setup is very similar to where we were before the big sort of June rally. I think the market is sniffing out the sort of top of the Fed cycle. I think bond yields have overshot and are now coming down. And I think, to your point on earnings, we're going into third quarter earnings season where, yet again, expectations are very, very negative.
Yeah.
And I think this is an attractive setup. I think we're just going to leap over this sort of low bar and breathe a little bit of a sigh of relief.
Ben, I want to go to your huge track record on 3 cycles of getting the market right. And I want to go to Lisa's gloom yesterday. I want to go to nodes of revenue guesses. What it comes down to is, with a slowing economy, everybody's going to try to guess revenues at the top line. Given all the economic mumbo, John, what are the nodes of revenue guesses going to do?
I think this is all sort of fear versus reality. I think markets, we're down 25%. Earnings expectations have actually fallen quite a lot, I would argue. And not all recessions are created equal. Granted, we're almost certainly going into a recession, at least outside of Asia. But this is not 2007. This is not 2020. This is, I think, a much more plain vanilla, central bank-driven recession. And I think that is, given where we are, I think that's actually pretty investable. That's a 2 percentage point GDP peak to trough fall. That's a 14% decline in earnings expectations, where I think you're at least halfway there. Again, I think where markets and sentiment and valuations are at this point, I think the bigger risk is being out, is being out, not in.
Okay, so Ben, given all of that, just quickly here, how much are you buying with your conviction? I mean, basically, are you loading up the truck?
I think we're building a bottom, right? I think this is a U-shaped recovery, not a V. I think the Fed has told us quite clearly that, they're going to stay the course until something breaks. Well, hey, stuff may be starting to break. We don't need the top of the Fed cycle. We just need a little bit of visibility that it may be coming in the next sort of 4 or 5 months, and the Fed's just not going to keep hiking here. I think all the lead indicators are telling that. So I'm comfortable enough saying we're building a bottom, so I'm fully invested. I'm certainly tilted a bit more to the defensives. Risks are still pretty high, but I'm absolutely nibbling at that sort of quality risk, that sort of big tech, discounted small caps. I mean, the more this goes on, the closer we get to inflation definitively coming down. I think you're raising the risk budget into that.
Ben Laidler, thank you, sir. Avi Toro, defiantly bullish on this equity market with equity futures this morning. Going in his direction, Lisa, at 1.65% on the S&P.
It says everything that you have to say defiantly bullish, because
it's been
so
a tough
rare.
year, right?
I know, but defiantly bullish at a time when a lot of people are saying that even a pivot isn't going to necessarily do the trick.
I want to quantify your opening, John, about the market lift we're seeing. The Bloomberg Total Return Index, the Full Faith and Credit All-In Index, it's up 1.56%.
We'll take that.
It's a launch.
Tom, we'll take that after the brutal year we've had so far. Brutal, my favourite word. Nodes are your favourite.
Oh, yeah,
words,
love nodes.
Right? Yeah, love that. Love brutal. Nothing brutal about this screen, though. Brutal for bears, maybe. As a one-off. Futures up by 1.6% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Ukraine, President Volodymyr Zelensky said that liberating settlements from Russian occupation is now the trend. His forces have pressed further into the eastern Donetsk region and seek gains in the south. Meanwhile, the Biden administration will announce another package of U.S. weapons within days. In the UK, Chancellor of the Exchequer Kwasi Kwarteng will try to reassure financial markets about his economic strategy. He originally planned to release his medium-term fiscal plan next month. Now, Bloomberg's learned Kwarteng will announce it sooner. He's been under pressure since the tax cuts he announced September 23rd led to a sell-off in UK assets. Tensions are increasing over Kim Jong-un's nuclear weapons program. For the first time in 5 years, North Korea fired a missile that flew over Japan. Now, that prompted a rare public safety warning from Tokyo. The missile splashed down in the Western Pacific, about 2,000 miles east of Japan. Former Meta Platforms Chief Operating Officer Sheryl Sandberg is donating $3 million to the ACLU for the fight for abortion rights. The organization says Sandberg's donation will give it a running start against state anti-abortion efforts spurred by the Supreme Court's overturning of Roe v. Wade. Bloomberg estimates Sandberg is worth $2.1 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
It was becoming a distraction, so that's why we immediately changed that policy, and that's the kind of government we are. We do respond when there are concerns, and we act quickly.
The British Prime Minister Liz Truss there earlier today from New York City this morning. Good morning. Sterling stronger for a sixth straight session. We've gone from 103.50 last week through 114 on cable. Just this morning, elsewhere, futures positive 1.8%, a lift again in this market. Futures positive with yields taking a dive lower by another 7 basis points on a 10-year, Tom, 356.96.
So moving very exciting into a raft of labor report that will pick up, I believe, on Wednesday, ADP, and on we go to the jobs report on Friday. John, I saw a movie, the Queen movie kind of thing, over the weekend, and there it was, 1945, and I wonder if this Conservative Party, where they adore Churchill, and the certitude in the movie that Churchill would win in 1945, war hero and all that,
sure,
and he got crushed by Clement Attlee. You wonder if we're going to redux that here.
There has to be space for a government to make a decision to change course if they want to. And they're clearly changing course after the pressure of the last couple of weeks. Joining us now is Bloomberg's Lizzie Burden in Birmingham in the UK. Lizzie, you're at the Conservative Party conference. There's now a conversation about whether the budget that was penciled in for the end of November actually takes place before the next Bank of England decision. What are people telling you about that?
Well, we don't have a date yet. There are rumours that it could be this month, speaking to MPs around the conference hall. And as you say, it would be ideally before November the 3rd so that the Monetary Policy Committee could take it into account. And it's not just what the government says that's important, it's also what the Office for Budget Responsibility, the fiscal watchdog, says, how much all of this is going to cost, how much growth it's going to create. Is the OBR less optimistic than the Chancellor about that? Because, of course, it was the absence of an OBR forecast from accompanying the budget in the first place that seemed to partly be the reason why the budget was undermined in the eyes of the market. So this is the U-turn for the markets. The U-turn for the consumer, for the voter, was the U-turn on the top rate of income tax.
Lizzie, on sterling, 103 to 113, is the feeling in Birmingham that it's all clear?
Well, I say that the bringing forward of the OBR forecast is for the markets. There remains the massive concern that you've got this huge package of tax cuts, and even the government admits that the top rate of income tax that they've now reversed was merely the tip of the iceberg, remains uncosted, unfunded. And it's not an emergency measure like the energy bailout. These are permanent, effectively. And this is, of course, what originally offended the markets. So are we going to see more reversals on these? It seems like it's open season now. Liz Truss has been bullied on the top rate of income tax by her own party. Remember, she wasn't even the pick of Tory MPs to be the leader. Are there going to be more reversals? Markets perhaps are taking a bit of comfort from the fact that this government seems to be a little bit more malleable than we thought from Liz Truss's Margaret Thatcher impressions in the first place.
Well, but Lizzie, to that point, is she actually less popular among her own party? In other words, does she have less power and less credibility in response to the U-turn, in response to her malleability by markets, by other Conservative members who pushed back?
I have to say there seems to have been a change of winds since yesterday. Yesterday, we were hearing that MPs were writing to the chair of the 1922 Committee of Conservative Backbenchers to try and remove this one-year immunity that Liz Truss has from a vote of confidence. That seems to have died down, but what my colleague Kitty Donaldson has reported, she's been lurking in the dark corners of the conference hall, is that even cabinet ministers are worried that Liz Truss is just going to be a lame duck for the rest of her premiership. And it's the first U-turn was the top rate of tax. Now we're going to see Liz Truss pushed around by Tory MPs on planning reform, on the cap on bankers' bonuses, and actually she may not be able to materialise her plan for economic reform. And if she can't do that, if she can't boost growth, then how are they going to win the 2024 election?
It's going to be a hard time, that's for sure. Lizzie, wonderful coverage in the last couple of days. Lizzie Burden, they're over in Birmingham, England, covering the Conservative Party conference. The government, Tom, under Liz Truss, not even a month old, and we're already having this conversation about maybe this is the beginning of the end.
Explain this to us. I mean, I go back to Wars of the Roses, and I think it was the 14th or 15th century as well. Nothing's changed, has it?
I don't think much has changed, Tom.
Nothing has changed.
I mean, how many times have we seen this movie play out in the last 5 years? Never mind the last several centuries.
Let's take a given junior cabinet member in trust. They get the big lift up there in 10 Downing Street.
Sure.
They're in the room. And then this.
All of a sudden, and the approach is changing. Let's be clear about scrapping the top rate cut that they were looking at, and now they've delivered a U-turn. It's 2 billion sterling out of 45 billion in tax cuts. It's tiny. The approach is the bigger point here. The approach has changed, but that's domestic UK politics. I think the issue across Europe is much bigger than that. The initial plan to cap energy bills, that was the big one. That was a lot of money, unfunded, uncapped liability, and then Germany's joined in too. And the controversy in Europe, for me now, at least for this week, is far more interesting than the drama, the soap opera playing out in the UK.
Especially because nations in the euro region are angry that they didn't have a better sense before Germany announced their fiscal spending plan of what they were going to be doing. This affects borrowing costs around the entire region. This affects the ECB's ability to tamp down inflation, and it affects their ability to really plan to figure out the other nations of what they want to do. But really, at the heart of this, how much slack is this bond market giving to fiscal policymakers to actually go forward with some of these plans?
This is the heart of the matter, John, and I don't mean your place in Notting Hill, but, you know, like 3 or 4 streets over where somebody's got 5,000-6,000 square feet, they get the same heating bargain that someone in the Midlands has.
The unit cost. The unit cost. They're trying to cap the unit cost.
To Americans, this is unimaginable.
So they're trying to cap the unit cost and therefore cap the overall average bill. I think it's been miscommunicated over the last month or so, but you're capping the unit cost. So if you consume more energy, Tom, you will have a bigger bill than someone who consumes less.
Okay.
You'll just be charged a unit cost that has been capped by this government. Okay. Did that make sense?
I'm learning everything.
Kinda.
Well, the problem is that ultimately this comes back to how do you dampen demand? Because ultimately, if you don't, then you're getting yourself into some sort of downward cycle where you're bailing yourself out only to have a bigger hurdle to bail out, right? I mean, that's essentially what the fear is. But it's not just the United Kingdom. And we were talking about how this is an idiosyncratic story. You had the IMF come out with that pretty shocking statement saying this isn't really responsible. But they're not alone when it comes to fiscal spending right now.
A headline out 20 minutes ago, I guess.
Sure. Where from?
Kremlin. Quite positive, that's their language, quite positive that Elon Musk seeking peace in Ukraine. I didn't know whether to mention it or not. I wasn't sure it was a real headline.
You've got 15 seconds to explain it. Do you think you can in 15
no,
seconds? No,
I can't.
I don't think I can either.
I looked at it and said, really? I didn't trust it.
Futures up by 1.8% on the S&P. Live from New York, this is Bloomberg. Live from New York City, equities looking good here on the S&P 500, pushing higher by 1.8% on the S&P. Equities up across the board yesterday on the S&P 500, the biggest one-day pop since July. We add some weight to it on the Nasdaq 100. Futures up by more than 2%. The why? You'll find it in the bond market. Yields lower aggressively so yesterday on a 2-year down 17 basis points on the session. This morning, yields lower again by 11 basis points on a 2-year to around about 4%. So we're way off the highs of last week, pushing 4.35. So yields lower, equities up. And guess what? Dollar weaker, sterling positive once again. Sterling climbing from 103.50 a week ago Monday morning through 114 today at one point. Tom, 113.63.
Is the crisis over?
Cable up a third of 1%. More to go. I think we've still got more to go. I'm not saying you're going to have the kind of volatility you had a week ago, but we've still got some issues to settle. And I think that's the bigger point.
And to watch the bond market maybe more than the easy-to-watch foreign exchange market will give you some of that perspective along the way. Right now, she has one of the greatest parchment streams in the United Kingdom, from Edinburgh to London School of Economics, with real expertise on China. The chief economist, T.S. Lombard. Freya Bamish joins us right now. Freya, just to start, are we in global recession?
I think we're heading that way. I don't think we're quite there in the US. China's probably coming out of its recession, but still very weak and not really going to get its reopening boost until H1 of next year. The real problem is Europe, and I think this is what's moving markets at the moment as well. That there's something much wider going on here than just the kind of the if I can use the term slightly candid delivery of the fiscal policy response in the UK.
I look for you at the news flow, and clearly Australia blinking is important. What are the ramifications for other central banks, including ECB, that RBA just decides enough?
Yeah, I think what's happening here is that there's a global shift towards a higher returns environment, but you can't get there all in one go. The real economy just can't handle it, and there are these sort of powder kegs of financial accelerators that have been left behind by the period of low yields in the 2010s. So trying to get from the 2010s level of yields to a pre-global financial crisis level of yields, which is where we think we ultimately will be ending up over the 2020s. Trying to do that in one mini cycle, which is the COVID cycle, is just too much for the real economy and for financial markets. So I think what we start to see now is that QE comes back in a very different guise from how it did in the 2010s. It's much more of the sort of the budget response to try to provide liquidity where necessary in order to prevent yields from rising more rapidly, rather than to try to keep yields from shifting lower. And I think the underlying forces here are much, much wider than the kind of the narrative, at least around the UK, suggests. What's happening here is that there's been a redirection of funds in favor of the energy firms, in favor of Russia, really, and the non-fossil fuel firms. And what that does is you're handing funds to companies and countries that are much more likely to want to invest them than they were in the recipients of those funds in the 2010s.
Well, Freya,
and in that process, you're dragging yields higher.
There's a lot there, and I want to just hone in on one thing that you said. That quantitative easing this time around is going to look very different. Does that mean that you think that quantitative tightening is over and then we're entering a new quantitative easing cycle of trying to reduce the pace of bond yield increases?
I think as far as the UK goes, yes, I would say that quantitative easing is sort of dead before it gets off the ground.
Quantitative tightening.
Quantitative tightening. Thank you. The quantitative tightening just doesn't really get off the ground. That you get this kind of QE that is not the same flavor as the 2010s, and it's there to prevent yields from rising too rapidly. And that is probably the case for Europe as well, where we're, if anything, more worried than we are about the UK, with Germany already having suggested that they're going to go alone on the fiscal front. Where does that leave countries like Italy, where we'd be much more worried about those kind of structural issues starting to re-arise in the euro area? Therefore, you get the move back to the TPI, which can very easily translate into something similar to what the Bank of England is doing with regards to its kind of short-term new flavor QE. So it's a very different flavor of monetary policy since the 2010s.
How much is this a European story and how much is this a global story? I mean, Tom was talking about the RBA blinking, raising just 25 basis points rather than a bigger rate hike that was expected overnight. How much is this the example rather than a story of specific nations facing specific inflationary pressures?
I think there are now so many different idiosyncratic problems that are arising at the same time that we can say that something systemic is actually going on. The European trouble, Europe is definitely at the center of this. I would definitely point out problems in China that can arise perhaps not till after the reopening, so therefore into the second half of next year. But I would definitely point that out as structural turning points for China as well. And I think because of this kind of updraw in yields that fiscal authorities are very much leaning against, you've got this battle for funds that really speaks to the longer term secular trends that have just been sort of fast forwarded by this energy shock, that deterioration of the geopolitical environment and the natural environment. These are all factors that are kind of nasty cost push inflation factors that speak to the need for higher returns and the likelihood of higher returns in the 2020s. And we're just seeing the fast forwarding of that in the short term. But I think it does lead to capitulation from central banks, first in the form of pushing back against the financial accelerators, as we've seen in the UK in the pension funds fiasco. But then in the case of Europe, as a result of the slowdown in growth, yes, governments are supporting their economies through fiscal spending, but the cost of doing that, there's no free lunch. The cost of doing that is that yields are much higher. So you're getting the spending on energy, but it's happening at a higher yields, and therefore the property market in the UK and yields more broadly are starting to tighten financial conditions and tamp down on growth in that fashion. So central banks turn from worrying about inflation in Europe to worrying about the financial accelerators and then growth. And therefore you get the capitulation in that sense. I think in the US, we are in a very different position here because inflation is more embedded, and therefore the policy response has to be still focused on inflation.
And this is the heritage of T.S. Lombard, Freya. I mean, model out how they get to 2%, given that a huge body of people say that's an impossible event. Do you just assume they get to 5% or 4% and then recalibrate?
I think that's probably where we're getting to further down the line, that they will eventually explicitly or implicitly revert inflation targets higher, just because there are so many secular forces that are pointing in favor of higher inflation, and not all of them being kind of cost push inflation. There's also this change in the relationship in global labor markets and credit as well that suggests that China is no longer a cap on wage growth in developed markets. Therefore, you have faster wage growth. You also have faster credit growth, and both of those things are inflationary. So leaning against that means you're kind of accepting this politically unacceptable idea of a much higher unemployment rate in order to get inflation back down again. But I think in the shorter term with the Fed, the point that I would get across is that there's too much reliance on leading indicators that are simply monitoring what the costs are doing, and that the demand supply imbalance in the US, both in terms of the goods market, still both in terms of the labor market, is still great enough that you've got this underlying heat in demand in the economy. And therefore, while the rest of the world has good prospects for a slowdown in inflation, I'm still worried that you get upside surprises in inflation in the US because margins have greater room to expand on the back of demand still remaining relatively strong. So we're very much looking out for that US recession coming through, because that's the kind of the key turning point for the Fed. But it doesn't seem like we're quite there yet.
Freya, thank you for being with us this morning. Freya Beamish of T.S. Lombard, just absolutely brilliant. And Tom, I'm so pleased you brought up the difference between Australia and the rest of the world. Bear in mind the RBA has a price target of 2 to 3%. That's a key difference here, 2 to 3% as opposed to 2. Consider also that inflation in Australia in the last quarter was running at about 6% on headline versus 8 to 9. So that's another key difference. And also consider how bad the RBA has been through the pandemic, Tom, as you sort out your bow tie.
That's a disgrace.
About forecasting some of this. Because the RBA back in the pandemic, Governor Lowe admitted this was a mistake. He basically said, you probably won't get a rate hike until 2024. And look at where we are now.
But that was all of the central banks. They've all gotten it completely wrong. The point that you made about 6% inflation, that is different than 10% inflation.
Absolutely.
That is different than 9% inflation. And when you're talking about that, you perhaps can push back, especially if the underlying drivers don't have the same kind of stickiness as in the United States.
And we're both on the same page on this. For the Federal Reserve, the overwhelming line of attack right now is to keep repeating the following line, which is, we are committed to not pulling back prematurely. Now, if the market conditions ease somewhat going into the next decision, doesn't that just make it easier to keep on hiking?
Right. Well, this is sort of the perverse consequence of the market not believing what the Fed is saying. Other people would argue that the Fed's tightening is affecting other areas other than just the stock market price just as much, if not more, in creating some sort of constriction in the economy. But either way, you're right. If the market doesn't buy what they're saying, it will force the Fed to more aggressively double down and actually complete what it is they're saying they're going to do.
Now, I get that goes against the theme of this morning, which is peak yields and Fed pivots, Tom, with the equity market up by 1.8%.
Yeah, I'm speechless here, John, because I'm waiting for the data, and all of this could change by Friday. But we have a June. Is it a June is busting out all over here in October? That's what it feels like.
The ISM
was
just a little
John.
hint.
That was a Broadway.
I'm letting it go. The ISM was a hint that maybe the data is softening just a little bit.
Or people want to see what they want to see in the data.
Isn't that always the case?
Yes, I mean, that's
using the RBA as an example as to why the Fed's going to pivot.
Exactly.
I mean, come on, are we stretching?
I mean,
that's
maybe.
a question. Possibly. Futures up by 1.8% on the S&P. You going to sing us out?
June is busting
out
all over.
All right. Okay.
Still has his hat.
Sure, everyone's going to stay tuned.
And many multi-talented Tom Keene. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The oil market is looking to OPEC Plus to deliver a substantial cut in supply at its meeting on Wednesday. The price of West Texas Intermediate was around $84 a barrel after rising more than 5% on Monday. Currently, many nations in the cartel can't meet their current production quotas, so any agreement on headline reduction in output would not lead to a drop in actual barrels. New York Fed President John Williams says the central bank still has a ways to go when it comes to raising interest rates. Speaking in Phoenix, Williams said interest rates are not at the level that would restrict economic growth. He said he expects real GDP to be at close to flat this year and grow modestly in 2023. In Florida, the death toll from Hurricane Ian has now risen to at least 68 people. And according to Modeler Verisk, insured losses are now estimated to be as much as $57 billion. President Biden heads to Florida Wednesday for a first-hand look. Bloomberg's learned that iPhone exports from India went over the $1 billion mark in the 5 months since April. It's a sign that the country is making progress with its bid to become a force in electronics. India's on pace to double its output of iPhone over a year. Rising exports bode well for Prime Minister Narendra Modi's plan to make the country an alternative to China in manufacturing. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Elevated inflation today is the most pressing issue facing monetary policymakers. And by creating long-term upward price pressure, then, secular shifts in supply chain management could present additional challenges for monetary policymakers during a period of already elevated inflation.
Raphael Bostic there, the Atlanta Fed president, live from New York City this morning. Good morning, a very good morning if you're along this equity market, because we have a squeeze, a bounce again, building on yesterday's gains on the S&P 500, pushing higher on the S&P by 1.8%. 1.8% higher on the S&P. Yields are lower by 6 or 7 basis points to 357.36. Off the back of that, this dollar's weaker, euro stronger, 98.97 on euro dollar, positive 0.7%. I blame Ed Yardeni for the last 24 hours, who came on this program yesterday and said the following: I think they have one more rate hike coming in November, and that will be it. He said that because the financial stability issue will pop up as a primary concern.
It is. In about every 7-8 years, there's the 3 books at the IMF, as I mentioned yesterday. And guess what? All of a sudden, suddenly, the Green Book matters. That's right where we are this time.
I'm not buying it. I have to be honest. I'm not buying it.
Bramo, that's why we love you.
Okay, thanks. No, hold on a second. I don't buy it because none of those financial stability concerns have actually bubbled over.
Sure,
we haven't seen them actually explode. So suddenly, we're expecting there to be a response to something that is getting prevented from happening because people don't buy that they're going to actually push things to that extreme.
Making it more likely that it might happen
Thank
because
you.
they're going to keep hiking.
That's the reason why I don't buy it.
There you go. You up to speed, Tom? That makes sense.
I think we brought the show to a dead silence.
I think a lot of people
Most people think that's a constructive thing.
Most people agree with you. If you ease financial conditions going into the next Fed decision, what do you think they're going to do? Makes it easier to hike rates again.
Exactly.
Doesn't
I'm just
it?
saying.
It is October, which means we must speak with Paul Sankey, founder and lead analyst at Sankey Research, who's ignoring this conversation. Paul Sankey has decades of experience in oil and knows in October there is Vienna, and there's also Park Lane, a string of hotels in London where the elite meet to greet in the oil community, as they do beginning today. It is the energy executive of the year is from Qatar. We'll pass on that, but far more CEOs together and the rest. Paul, is a consensus opinion that oil will rise back into the hundreds?
Yeah, I think so. I mean, the first consensus is that we'll get a 1 million barrel a day cut from OPEC tomorrow, and what people here are saying will be a brief meeting. I was told that the decision's already taken. I was actually hoping that they would take some time and argue a bit so I'd get a chance to get out to Vienna towards the end of the week, but evidently the decision will come tomorrow. That should be, I think, a 1 million barrel a day cut. We've got about half of that probably Tom actually delivered, but it's still enough to tighten what's effectively a market imbalance in Q4. So any cut will effectively serve to raise prices.
The elite meet to greet at the Intercontinental Hotel or at the Dorchester with umbrellas in their drink, but is it just about Saudi Arabia and Russia?
Well, I have to say I've got to wear a black tie tonight for the award dinner, Tom. I need your help with the bow tie there. But yeah, no, I mean we had the CEO of Aramco talking very eloquently. Ben Van Beurden of Shell also very eloquent. We had protesters outside the Intercontinental yelling in my ear as I walked in. But the problem is the protesters don't really have a coherent solution. In fact, nobody does, and that's one of the issues. A couple of interesting points from Shell, for instance. He said that this quarter alone, China is adding more coal production than in the entirety of Shell's energy production. So essentially in one quarter, China grows coal by the entire size of Shell. And again, talking about the CEO of Aramco, again, talking about lack of spare capacity and how demand is remaining strong. Well, so again, further to your first question, it's all pointing towards higher prices, basically.
And that's really the crux of the matter. How much is this potential cut of 1 million barrels really an issue of a lack of capacity rather than the appearance of lack of demand? And how much pushback will OPEC Plus get from the United States, from Europe, saying, we need lower prices at this point to stave off a crisis? Why are you effectively causing an increase in prices or potentially laying the groundwork for that going forward?
Well, Lisa, you made a great point, which I'll come back to. But firstly, yeah, I think the Saudis have enjoyed $100 oil and, would rather we were closer to 100 than to 80. So that's point one. Point two that you made is that they're so tight on spare capacity that they may well feel that, to rest their fields a bit, to give themselves some more breathing room, a cut is a good thing. The outside chance was that there'd be a major quota renegotiation, but it doesn't sound like that's happening. These guys are still using 2018 quotas, which are just completely nonsensical now in terms of things like Nigeria and Angola, just not even close to their quotas. But I don't think there's going to be that kind of agreement. I think it'll be a pretty strong cut decision led by Saudi, UAE.
15-minute meeting?
Of course, we've got the other interests. We've got Russia. 15
minutes or more for this meeting?
More than 15, I think. Those ones were just rubber stamps. But it may be. I think. Well, I was hoping it would take longer than a day and roll into Thursday, Friday. It sounds like we'll get a decision tomorrow, and before the markets in the US tomorrow. Yeah, could be.
There we go. Paul Sankey, thank you, sir. Good to see you. Paul Sankey there of Sankey Research. It's a turnaround, isn't it? Remember a number of months ago in the summer when President Biden went to see the Crown Prince of Saudi Arabia, Mohammed bin Salman. There was a fist bump. It was like that, TK. Like that. Nice. There was a fist bump. There was a hope. Come on, Bramo. Don't sit it out. There we go.
Group fist
nice.
Bump.
There was a fist bump and there was a hope. There was a hope that maybe they would loosen things up, and now they're talking about a big cut.
Do you feel like that those fist bumps were just as awkward as President Biden's?
I don't think anything comes close to how awkward that fist bump was in Riyadh.
Okay, so that's good. That sets the bar low enough for us to succeed at.
That's why we did it.
But I do think it's going to become a political, real big issue, especially as we've seen a plateauing in gasoline prices. They basically bottomed out in how much they're going to come down. And this has been a huge political issue heading into the midterms at a time when this has been the one thing going for the inflation year-over-year inputs for the United States.
I'm looking at a technical chart, John, too fancy for TV, and the answer is resistance rather for Brent crude is $98 a barrel. So we're $10 away from where I begin to get excited about a trend change.
Potentially, Tom, going into a global recession, you can see why OPEC Plus is having this conversation. It does make sense, does it not? Yes. The other thing that Paul Sankey said that stands out for me, coal in China. I mean, this is problematic, isn't it?
Yeah. Talk about from a green energy standpoint, from this question of how much pollution is going to be put in if they're supplementing the equivalent of, what did he say, Exxon's total? Shell's total output with coal.
In a single quarter.
In a single quarter. It really speaks to, on one hand, potentially they're generating more economic activity, which could speak to also demand not exactly slowing as much as it might be. Again, this goes to the point that Paul Sankey was saying, that perhaps a 1 million barrel cut is more an issue of a lack of capacity from some of these nations than really reflecting a cooling in demand as they perceive right now in the market.
You got a sense of that worry through the summer.
100%.
I think we got a really big sense of that, Tom, the concern from people in this oil market about the lack of spare capacity, that these guys in many places were at maximum.
And the Marshallian cross, on radio it's tough to do it, but I got my fingers crossed. The petrol Marshallian cross is much, much, much more sensitive than we perceive.
Translate that, TK.
The two lines crossing are really, really hypersensitive, where one little thing moves and the equilibrium gets out of point. And in this case, there's a constraint in Saudi Arabia, so that moves that price higher. Am I doing okay here?
That was beautiful. That was beautiful.
You know.
That worked wonders. I think it really worked
That's
out.
right.
That was an intriguing segment, wasn't it?
Yeah, well, I got an umbrella in the tank, so it's good.
Someone asks, what's going on with oil?
That. This is Bloomberg.
The big issue here is, does the Fed get the kind of controlled moderation in labor markets and growth?
We just haven't seen that rise in the unemployment just yet.
We are starting to see some companies rip off the earnings mandate.
Markups are insanely high everywhere. People have been gouging prices for any goods.
I think what's breaking is the soaring dollar.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Peak everything and a sprinkle of capitulation. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Futures positive. TK, a bit of capitulation out there across Wall Street.
A bit of June and capitulations there we cover. I don't know what the shorts are doing on the short cover, but what is happening is we're all looking to Australia first to blink.
First to blink. Are you calling that a blink still?
Yes. Oh, come
to
on.
Go 25 instead of 50. That's
beeps,
a blink.
They went 25, and you saw it in Aussie Kiwi, and you saw that's the currency pair.
Thank you for that. I appreciate that, yeah.
I didn't know New Zealand is to the east of Australia. I thought it was way over to the west.
You got out the map.
That's how dumb I am.
Okay.
Anyways, I think Australia is the first to blink. Will we see more of that given the data that's coming in?
It plays into the theme of the moment, Lisa. Yields lower, yields lower.
I don't know if I would agree that they blinked. They perhaps ratcheted back the pace. And that, I think, is actually one heated debate among Fed officials, as according to Bloomberg reporting, that it's not so much the destination that's the big question at this point. It's the pace at which they will raise rates. Do they want to front load it, and are they willing to experience some sort of breakage akin to the financial stability risks that Ed Yardeni was speaking? Are we seeing perhaps not a blinking, but perhaps a retracement in the pace of how much and how quickly some of these central banks are going to raise rates?
We talked about the step down through the whole of the summer, from 75 for 50 to 25 at the Federal Reserve. Doesn't this rally just make it more likely they go 75?
Right. I mean, this is sort of the perverse element of the whole thing, is that the more the markets get comfortable, the more the Fed is going to have to be that much more aggressive and end the party.
Do you want to do a bit on capitulation? Keene, the big bull at JP Morgan, Marko Kolanovic, comes out with a note last week, adds to it yesterday, says the following. Our 22 price targets are at risk. That's one. So that's the big bull on Wall Street. I would say there's a bit of capitulation in the mix there, even though he's not admitting
from others.
it. Okay.
From others.
You want to do the others? Ray Dalio of Bridgewater. When the facts change, I change my mind. This is what he had to say. I no longer think cash is trash. Lisa, your take on that?
It's, you know, he was talking about adjusting to the facts, which have changed, and basically he's getting on board with a trade that's already gained a lot of steam, right? I mean, if you think about it, I was looking, for example, at this ETF of T-bills that has seen more than $10 billion of inflows so far this year. People have been flooding to cash. And finally, he's saying, okay, hold on a second. Actually, it's not terrible.
Tom, Ray Dalio, do you remember when he said cash was trash in Davos?
Yeah,
those years ago.
You know, my problem with this with triple leveraged all cash is I'm doing 2 and 20 on triple leverage.
You've done great this year. Big inflows.
It's working out great, but at some point it ends. What I'm going to suggest is when the facts change, which is why we need to focus on the facts along with the well-intentioned punditry that we listen to
data
every day. The
Payrolls
data
Friday.
to me matters, and I'm sorry, I'm going to payrolls with a 3-month moving average. I can't remember the number, 268,000.
It's a sizable
That's
number.
not Powell friendly.
The mantra, don't fight the Fed, is now in reverse. And the Fed keeps saying, we're not going to blink. We're not going to retrace. That's what caused Ray Dalio to move away. That's what caused Marko Kolanovic to get very annoyed at the Federal Reserve because they weren't cooperating with his thesis.
He sounded annoyed, didn't he?
He did.
Just a little bit, or maybe a lot.
Yeah, he was saying they're going to do policy error.
The line of the Fed speak at the moment is we are committed to not prematurely loosening policy. That's what you heard from Vice Chair Brainerd earlier this week. Futures right now, they are positive in a big way. They add to the gains of yesterday. Let's whip through the price action for you on the S&P 500. Equities up by 1.6%. Equities up by 60 points on the S&P. Yields are lower by 5 basis points to 358.94. Your 10-year yesterday was down 17 basis points, 17 or 18 basis points. Your 2-year was down that much as well. So we are well off the highs.
4% a cup of coffee
last
ago.
week. Last Wednesday, Tom, 4%, north of that level. Right now, your 10-year, 358.74 off the back of that TK, some dollar weakness, euro strength.
This is curve moving, not elastic. 210 spread is pretty much unched all in all.
Whole thing just shifting lower.
Shifting, that's
curve
the
just
right
a little
word.
bit steeper by a couple of basis points today, but really the whole curve just shifting lower. Euro dollar, Lisa, 98.97, positive 0.7%.
Yeah, but still hovering below parity as we look at dollar dominance, and perhaps it's not going to change that much. We get a slew of Fed speakers today. Lori Logan of the Dallas Fed, John Williams, Loretta Mester, Mary Daly, line them all up. They're all speaking today. Perhaps they will all repeat what we heard from John Williams yesterday, which is they are committed to continuing with these rate hikes. So don't fight the Fed. Is this belief in a pivot that the market seems to be buying perhaps premature if the Fed is saying don't do it? And yesterday, just to give you a sense, we saw the biggest one-day drop in 10-year real yields going back to March of 2020 as people start to believe in this idea of a pivot. At 10 a.m., we get the JOLTS data in order for job openings in August to give some semblance of where we are in the labor market. In the July reading, this to me shocked me. We actually saw an increase in job openings. How much are we actually seeing the labor market cooperate with what the Fed has been really saying they want to be seeing? And how much, and John, you've been really talking about this, are we looking at a lagging indicator in order to dictate future policy? And it sort of creates this real dissonance for the Federal Reserve and, frankly, for markets trying to get their heads around it. And at 11 a.m., we hear from ECB President Christine Lagarde. She is in Cyprus speaking with the ECB president of that particular bank at a time when you're seeing the same pivot discussion happening in Europe. It is slightly different as you see yields come in pretty dramatically yesterday and again today. John, it is different because there is this belief, as we were hearing from Freya Beamish earlier, that they will engage in some sort of quantitative easing to buy bonds, to suppress peripheral yields, to control the pace of increases in order to control financial stability.
And keep on hiking simultaneously.
Yes.
Unreal. Lisa, thank you. That's your day ahead. Let's get to Amy Wu Silverman, the equity derivative strategist at RBC Capital Markets. Amy, wonderful to have you with us on the program. Your words, a shoe and a half has dropped. What do you mean by that?
Well, look, I think the question of the day has been, where we are in terms of capitulation in the volatility markets. That's certainly been, the question. And we've had kind of a regime change, right? And we've kind of had a reprieve now. But we had been watching since August, John, for a pickup in volatility for September. I think we've certainly got it. We have VIX up 22%. That's the third highest on record this past decade. I actually do think there's more to go. So I guess a shoe and a half instead of the full two shoes.
Amy, I look at where we are through a fractious third quarter, and I've got a gauge in the fourth quarter. Do the cross moments work right now from variance on out to kurtosis and skew? Do the cross moments work? The derivative mathematics, does it work now, or is it less useful?
Yeah, it's been an interesting narrative, Tom, because with the skew, the kurtosis, the tails, these are all the metrics we look at in options. And the narrative has been that it's been quite broken this entire year. I don't really know that has shifted too much. If you look to historical skew levels and tails, they're all still quite low. And I think you have to kind of bear in mind that when you're an overall higher volatility regime, these numbers seem on a relative basis lower, but the reality is we're just at such nosebleed levels, right? So the math kind of doesn't work in your favor from that perspective, but it certainly doesn't mean that people are not buying tails. We are seeing it even with the reprieve we're getting in the market right now.
Amy, you said that September will go down as the third most volatile month in the past decade. And some people looked at this and said, okay, now we're worried about financial stability risks, and it's going to cause central banks to pull back from some of their rate hiking plans. How much are you seeing this in the opposite way? That basically the stress tested a market that is seeing liquidity withdrawn, and that it passed, that we didn't see anything break. So it actually gives Fed officials conviction to keep going.
Yeah, it's interesting. And, let's say that is true, Lisa, that could thereby, keep them on their path, which would actually generate more volatility. So it's this interesting cycle that we're seeing. I think that, historically, when you look to October actually tends to be the most volatile month kind of across the past decade. And that's even with the bump that we got in September. I think that especially with a critical earnings season, that's going to continue. Again, I think this reprieve is sort of the fact that we've gone through a big quarterly expiry. We sort of have this kind of no man's land of idiosyncratic data for the next 2 weeks, but then, we're going to be back in the hopper again. And so I would say that, don't count volatility out now, even though we're kind of dropping back to 20 handle levels.
Amy, it's one of those days, isn't it? Because the equity market's up. We'll be talking about peak Fed, peak yields, peak dollar, peak volatility. Amy, a feature of your research through much of the summer, much of this year, is just how much we're going to shift towards a higher volatility regime for longer. Amy, can we just end on that? Have clients got on board with your view of thinking beyond, say, the next quarter, into next year, and perhaps longer than that?
Yeah, I think so. And I think it has to do with the fact that when you shift to a different rate regime, it is, by its nature, something that has to shift along with it. But one thing I will tell you that clients are looking at is, you were talking about how cash is not trash any longer. The other thing that's happening is yields are incredibly attractive. So, you have a stock like Apple, let's say, which really is only down 2%, but it's been a very bumpy ride. And so the volatility on that has more than doubled. That's essentially how much yield you're collecting on something like that now. And so even with a higher volatility regime, people are looking at higher volatility harvesting on kind of attractive names of high quality.
Amy Wolf-Silverman. Amy, thank you, of RBC Capital Markets.
Volatility harvesting.
You like that?
That is so Wall Street.
It's incredibly Wall Street.
It's like picking apples or something. The autumnal glow, John, of going north up the Hudson
Are you
River
still dreaming about
and
fall?
apple picking?
An apple picking.
Let's go up in volatility. Let's harvest some volatility.
Would you like to take a derivatives expert?
Folks,
to go
what she's talking about there is
picking?
pulling in premium and harvesting the price of hedging and bringing it into you.
Volatility, higher vol for longer is the point that Amy's making here, Tom. And I think that resonates with a lot of people.
Yes.
I wonder also, if we can just pause for a moment, because on days like today, we will be talking about peak yields, peak Fed, peak dollar, peak vol, all of the above. What if this is it, that we just kind of hang out at 4% on a risk-free rate, 3.5 to 4%?
Yes.
And how much does that change the market from where we were through much of the last 10 years?
Especially with borrowing costs, you haven't seen companies actually have to re-engage with the market at these levels. When they do, suddenly their entire model starts to change.
Futures up by 1.7% on the S&P. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Ukraine, President Volodymyr Zelensky said that liberating settlements from Russian occupation is now the trend. His forces have pressed further into the eastern Donetsk region and seek gains in the south. Meanwhile, the Biden administration will announce another package of U.S. weapons within days. In the UK, Chancellor of the Exchequer Kwasi Kwarteng will try to reassure financial markets about his economic strategy. He originally planned to release his medium-term fiscal plan next month, but now Bloomberg's learned Kwarteng will announce it sooner. He's been under pressure since tax cuts he announced on September 23rd led to a sell-off in UK assets. Tensions are increasing over Kim Jong-un's nuclear weapons program. For the first time in 5 years, North Korea fired a missile that flew over Japan, and that prompted a rare public safety warning from Tokyo. The missile splashed down in the Western Pacific, about 2,000 miles east of Japan. Bloomberg's learned that the Biden administration will announce new restrictions on China's access to U.S. semiconductor technology. That's an escalation of Washington's efforts to stifle Beijing's industrial ambitions. It could also hurt growth in the $550 billion sector. And former Meta Platforms Chief Operating Officer Sheryl Sandberg is donating $3 million to the ACLU for the fight for abortion rights. The organization says Sandberg's donation will give it a running start against state anti-abortion efforts spurred by the Supreme Court's overturning of Roe versus Wade. Bloomberg estimates Sandberg is worth $2.1 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Of course, we are facing difficult times. We have an unprecedented level of inflation since the creation of euro. The key point is to stand united. And that's why I really think that there is a need for a global action plan at the European level against inflation.
Bruno Le Maire there, the French finance minister, sitting down with the brilliant Bloomberg's Maria Tadeo, live from New York City this morning. Good morning. We'll catch up with Maria in just a moment. Allow me to whip through the price action for you on the S&P 500 and beyond. We build on the gains of yesterday with a move higher of 1.6% on the S&P. Equities up by 59 points. Yields lower by 4 or 5 basis points to 359. Yields down, stocks up, dollar weaker. Euro dollar 98.83, euro dollar positive 0.6%. Ray Dalio of Bridgewater says cash is no longer trash. Connor Sen of Bloomberg Opinion out on Twitter this morning responding to some of that perhaps. Strange to wait until a 60-40 is down 20% plus on the year to say cash is no longer trash. Would have been a good flip 10 months ago.
It's what it is. Everybody's adjusting, John. I don't know what else. We're going to see more like Ray Dalio, readjusting
We've seen a little bit of it.
The bull at J.P. Morgan, readjusting.
It took a while,
others.
didn't it? It took 10 months.
You wonder if this is almost like the 1231 readjustment, 3 months early.
3 months early.
I would
into
wait
next
for
year.
the data. I would wait for the data, and I can't remember who it was who said this Friday's jobs report really set you up for the November Fed meeting. We will have to see on that. Futures up 61. Maria Tadeo in Luxembourg on the events here. I've got 5 ways to go, Maria, and I'm going to go to a headline from the Kremlin of an hour ago, I guess. They say 200,000 mobilized. Translate mobilized, Maria, if you can.
Well, Tom, first of all, I'm not even sure that number is accurate because at this point we've heard so much from the Russians, and then in real time they do the complete opposite. And some of the evidence that we have is that it has been very difficult to bring men to the front. There has been questions about the kind of training that they have. They're facing a professionally trained army like the Ukrainian army is, the kind of equipment that they have and the kind of conditions that they operate in. So a lot of this, I would be very cautious, and it's always difficult to tell what the Russians would spin, what's propaganda, and the actual reality on the ground. And the reality is, on the battlefield, the Ukrainians are making headways.
And among others, John, James Stavridis, the Admiral Supreme Allied Commander, he's hugely suspect that they can, quote-unquote, mobilize 200,000.
This is the tension on the ground. We need to talk about the tension within Europe as well. Maria, talk to us about the tension between the German government right now and that package they announced in the last week to help people experiencing high energy prices and what the rest of the Europeans are saying about it.
Oh la la, this is a heated one, and it really is behind the scenes. Now, a number of things. You have to go back in time for the past 7 days. We had the Nord Stream explosion. Then immediately after, the Germans came out with a mega package. 200 billion euros is a political message to tell Russia, okay, we have a response, and we can deal with this, and we're willing now to spend. Do not mess with Germany. The problem is that this has repercussions on everyone else. Not everyone has the fiscal capacity that Germany has. And today we've seen the reaction. A number of countries saying that they worry that this is going to create fragmentation in the euro area. They also worry, by the way, behind the scenes about the lack of communication and clarity. They were taken aback by this mega package. They were not expecting it. And then, of course, I also spoke with the French finance minister who said at this point it should be clear to everyone that the only way to deal with this crisis is on a European level. This is not every man to himself. It has to be done jointly and in coordination with all member states.
Maria, what's the German response to that?
Well, you know, it's going to come handy, but this morning I happened to bump into Christian Lindner. I put that question to him, and he said there has been some miscommunication, perhaps a misunderstanding of what the Germany or the German plan wants to do. He says overall 200 billion euros looks enormous, but the size of the German economy would fit in that. And he also says we're responding to the size of the problem, which for Germany, it's also enormous. He says we're not the only country to come up with domestic measures. Other countries are doing that. It's just the size that changes, but sometimes size does matter in life. And here it has created political tensions behind the scenes. There's no question about it.
Keep it together, Lisa. It's not funny.
Maria.
All right. Stop it.
Never
Maria,
change.
thank you. Maria Tadeo of Bloomberg, thank you very much. I'm not going there. I'm going straight to a note from Citi and Andrew Hollenhorst.
I saw that.
Who says the following. We continue to see fundamental economic risks as balanced toward higher rates and lower risk asset prices. Tom's going to love this. Friday's jobs report is growing in importance. A softer reading would continue the, quote, Bad news is good news for equities, narrative, and vice versa.
I have nothing.
You've got nothing to offer.
I have nothing to offer on good news is bad news is bad news. The nodes of good news and bad news.
Veronica Clark City is going to join us a little bit later so we can explore this note a little bit further.
And let's just be clear, they're only nodes of bad news. Otherwise, it's shoots
over
of
there
good
on
news.
that
Let's
side
just
of
be
the
real
desk, that's
honest.
true.
But, the other point that they're making here, Holland Horse's team, is that right now, still, the economic risks are tilted to higher rates and lower risk asset prices, right? They're not necessarily seeing the groundwork, and certainly we're not seeing that with the initial jobless claims, that the labor market is really loosening enough to really give the Fed pause. And we heard from JP Morgan's Bruce Kasman yesterday that it would take 3 consecutive months of 100,000 jobs being created, which is incredibly low, in order for the Fed to really second-guess their moves.
Standout conversation of the last week or so, for me at least, was Tom Porcelli of RBC, who basically said it's going to take a lot of work to get this labour market to crack. And the line that I've heard from several people over the last couple of weeks is that you can't fire what you couldn't hire. We've experienced 2 years of corporations trying to get lots of people onto the payroll. They can't find them. Job openings are sky high. So if you're looking for the labour market to crack, what's going to crack? They couldn't hire the people. That's why we're hearing so much of the word hiring freezes, not layoffs.
Yeah, I think Lisa mentioned it earlier in her brief. I was making some fresh tang, but JOLTS, I'm sorry, the JOLTS survey is a signal of that.
And at this point, though, and this was sort of the tension in Tom Porcelli's point, if you have high inflation and you don't have a labor market that's showing signs of great weakness, how do you know you're making progress towards your ultimate goal? And it really puts the Fed in a bind. So even if he's right that that's a lagging indicator that's not going to crack, then the risks are even greater that the Fed's going to over-tighten and create a real downturn in order to achieve lower inflation.
Let's put the two things together. Peak Fed with claims sub 200K. Does that add up?
Well, if you say that there has been a structural fundamental change in the labor market, maybe you could make that argument, but the Fed's not making that argument.
Tom Titsura is going to join us soon, the head of fixed income research at Strategist, which I'm told is a bad company. They like that. Strategist, a bad company.
Yes.
Why not just bad? Anyway, futures up by 1.5% on the S&P 500. From New York City, this is Bloomberg. Not lost on many of you that the very moment Ray Dalio of Bridgewater says cash is no longer trash and the defiant equity market bulls over at JP Morgan start to crack, this market starts to rip yesterday and again this morning. Good morning to you. Equities up on the S&P 500 by 1.5% or so, on the Nasdaq up another 2 percentage points, driven by what's happening in the bond market, arguably, with yields dropping ever lower, 2s, 10s and 30s. On a 2-year last week, 4.35. On a 10-year last week, 4%. Right now, 3.58 on 10s, on 2s, 4.02%. So the 2-year now is where the 10-year was, I think, last Wednesday. Yields down by about 5 basis points on a 10-year, down by 8 or 9 at the front end of the curve. So yields down, equities up, and guess what? The dollar weaker for a 5th straight session. If we close weaker here, TK, longest losing streak for the dollar index going back to September of 2021.
In the literature you're reading, is it a regime change? I don't see that yet, John.
Too early, TK, too early. But certainly what happened with the RBA a little bit earlier this morning has fueled this conversation about peak rates, peak dollar, peak hawkishness.
Absolutely. It was going
worldwide
before, but Australia was doing 25 beeps, not 50 basis points, folks, was like you say, the fuel off the Pacific Rim.
Though, as Bramos pointed out several times this morning, she's right to frame this, to push this argument, because many people are on board with it. The more this market rallies, the more likely it is that this Fed is not going to back away anytime soon. That's the cross-asset price action. Let's get you some single names and say good morning to Lisa. Morning, Lisa.
Hey, John. The single names are basically a continuation of the story that you're telling. Which names do best in the regime that you're talking about, of a Fed potentially backing away, potentially pivoting, if you want to use that word, from some of the aggressive rate hikes? You see big tech doing really well, standing out. Amazon shares up nearly 3%. Apple shares up nearly 2%, the same as Facebook's parent company, Meta. This comes even though Meta is saying that they're going to be a smaller company next year than this year. It comes even though Apple is facing a number of headwinds with the semiconductor space, indicating a much slower pace of demand. And this comes even though Amazon.com is going to be at the crosshairs of less consumer activity if you do get some sort of pullback in consumer spending. This raises a lot of questions. Are we just seeing the high flyers fly once again in a knee-jerk impulse of this market to basically go into the high beta tech names as the next leaders of this market, the same as the old, even though a lot of people are saying this isn't going to be the case? And what you're seeing with Rivian, which is this electric vehicle maker, to me, really symbolizes what you're seeing. These shares are up nearly 9% because they indicated that they're actually producing more than expected. This comes after Rivian disappointed quarter after quarter. The shares are down more than 60%. How much are we seeing sort of the last gasps of the old playbook, Tom, rather than the creation of a new one in the face of a very different regime?
It's a toxic brew right now in the equity space. I would point out, Lisa, Apple off the August peak, down 18%. This is an exceptionally important conversation for Global Wall Street. Working with Jason Trennert at Strategist, taken out by Baird, is Thomas Sitsoris. He's head of fixed income research here and combines economics and mathematics like no one. Tom, I'm going to cut to the chase and go Fibonacci 101 on you, which is which matters right now, the nominal yield or the real yield? Which should we study?
Oh, definitely the real yield at this point in time. I mean, basically, that's your indicator of how tight liquidity is getting, and real yields are still rising, at least as of last Friday.
They're rising as of last Friday. The 10-year real yield has come in. Which duration of real yield is the most valuable for Global Wall Street?
For financial assets, absolutely the 10-year part of the curve, 5s to 10s in general. If you're talking about Main Street economy, you're talking about more like 1 to 2 year part of the curve.
I mean, I look at the spread that we have, and as John mentioned with Citigroup, the importance of economic data, the jobs report, to guessing the Fed parlor game. Do you agree that economic data dependency now is critical in your fixed income space?
Yes, and typically under normal circumstances, we're most worried about that labor market report. I focus on the average hourly earnings, but you could look at employment costs. But that Friday average hourly earnings is always the most important data point, I think, in any given month, but especially so now because inflation is still sticky. Core inflation is around 5.5% to 6.5%. That's where wages are. That's got to come down for the Fed to eventually pivot. Until that comes down, I don't see a Fed pivot.
Tom, you know the conversation this morning. It's frustrating for many. Equities up, yields down, peak Fed, peak hawkishness, the RPA's blinked. We're getting carried away here. Does this rally make it more likely the Fed goes 75?
I don't think it makes it more likely the Fed goes 75, but I think what the market is saying, first of all, we're looking at a classic short covering here, both in equities and bonds. Position A gotten stretched last week. The Bank of England has, for the time being, has blinked already. And so the market is saying, well, now we've got a weak manufacturing report. The Fed's going to be blinking soon. And I don't think that's necessarily true. But I do think that the rally is telling us that there are certainly investors who were short before who are worried the Fed is going to blink. So I don't know if there's a direct correlation just yet. We got to see that Friday labor market report first.
So what would you be doing in a situation like this, especially given the volatility that we were just talking about with Amy Wu Silverman?
Well, on the fixed income side, we now need to be tactical duration. That is, you have to be actively managing your duration exposure. You can't just be forever short duration, forever long duration. You also need to be managing tactically your credit risk exposure, particularly in the high yield side, but also in the investment grade side. But we're looking at sell-offs in bonds as a time to buy and deep rallies as a time to sell.
And what exactly are you buying? I was looking at a Bank of America survey of investors in the debt space, and they actually were more underweight investment grade credit than high yield, basically saying they're not going to see a default cycle akin to what they have in the past, that instead this is going to be rate driven and dislocating borrowing costs for companies around the world, just regardless of the rating.
Well, I think that's what we've already seen so far. We've seen a rate-driven sell-off in investment-grade credit, which has, for the most part, spared high yield, particularly the energy-focused space of portion of high yield. But that's going to change in 2023 as the economy looks like more and more like it's heading towards a recession. So we're going to go into a classical, more typical credit cycle with earnings contraction as well.
What does your world mean to Jason Trennert, who founded Strategist out of Ed Hyman's shop. What does the thesaurus world mean for Jason Trennert in his enthusiasm on American equities?
Well, basically the way I phrase it is the world's most important financial indicator is the 10-year Treasury, and that's going to feed into your equity multiple. On top of that, you're looking at essentially real yields, as we talked about earlier, being a drag on essentially nominal earnings, not just real earnings, but nominal earnings. So they both feed into both portions of your equity valuation, earnings and multiples.
One piece of feedback I've had across the Bloomberg today, and I've seen this from multiple people, how reliable is this bond market right now? We're really struggling, it seems, to price the risk-free rate. And if I can't price the risk-free asset, how on earth am I meant to price the risk asset? How reliable is all this?
Well, the more volatile the 10-year Treasury is, the more reliable it is. That's what I would say.
Why is that?
Well, because yields are not meant to be static. The period that we had, not just the last decade, but the decade before, was unusually stable yields. Even in the early 2000s, you saw yields more or less muted versus what they were in the 70s, 80s, and 90s. That's not normal. When you get back to a more volatile 10-year part of the curve, where in any given year you can lose 5% or make 10%, that's when the financial markets become, for lack of a better term, vetted. They become properly priced. And that's because 10-year yields themselves start to build in a risk premium for duration. That's what we're starting to see. It just so happens that a lot of folks don't like that, and they haven't seen that in a long time.
Hold on a second. Perhaps this means that it's more reliable from a market pricing perspective. This doesn't mean it's reliable if you want to go long Apple, right? It doesn't mean that it's reliable if you want to price risk assets. It's a distinction, right?
Yes.
And so can you draw the distinction of how much of a pricing it means for the global financial system to see a range that is true price discovery for the first time in decades?
Yeah. So the way to think about it is it makes it much harder to be a leveraged investor, particularly if you're going to use leveraged positions in treasuries as your quote-unquote glue. So if I'm a risk parity strategy investor, if I'm a volatility chasing strategy investor, and I use a lot of leverage, this makes it very hard to deploy those strategies. So it makes those strategies less reliable.
You were a legend at Fannie Mae. What does a 6.85% 30-year mortgage do to the American housing market?
Completely grinds to a halt. There's no refis. Even cash-out refis are dropping.
Price drop how much, roughly? It's an unfair question, but go with it.
On a regional basis. I mean, let's look at the early 1990s as an example. That's probably our best example with the Iraq invasion of Kuwait. I grew up in New England. We had home prices off 50%.
The Red Sox sucked that time. I get it.
They did. 1990, I think we got swept by the A's or
yes,
so.
Yes, we did.
So it's a regional phenomenon. You're looking at a similar pattern, particularly with high energy costs in the Northeast. In the Northeast, there could be parts of New York, New England, New Jersey. They could be down 20, 25% in the next 12 months.
Right.
But on a whole, the national economy, you're probably looking at home prices flat or maybe even up low single
Asking
digits.
for a friend from England who's looking at the 60s and 70s Upper East Side. What's it look like there?
I think New York City is going to see a bit of a strain here because you're not just talking about high mortgage rates. You're also talking about essentially the flight from the city, the work from home, or the lack of work to come back to the office. So all of those things are going to affect the city economy, perhaps more so than you typically would see in a downturn.
You'd give away my home address if you had it, wouldn't you? You really would. Tom, thank you. It's good to hear from you. I live on the Upper East Side.
Absolutely brilliant. Folks, what you just saw there
Strategist.
was a mathematical clinic. I can't say enough about it.
What do you have to say on the bond market? I guess a feature of normalizing, going back to something that a lot of people haven't lived for a long, long time because of the distortions and intervention we had from central banks for the last decade or so.
John, my quote of the third quarter, the great Nassim Taleb, the risk-free rate run away, and all of a sudden the gravity's back in physics.
The gravity's returned. The central bank's getting out of the way, Lisa.
So if you talk about a more reliable bond market, suddenly it changes the notion of it. If you're talking about that actually you'll have a two-way bid market, right? But what this means is suddenly it gets more exciting to go into the bond market in a way that perhaps takes attention away from the other markets. This is a new regime.
Isn't that a good thing?
For who?
I think it's a great thing.
It's a great thing if you're a bond investor. It's a pretty negative thing if you've been long big tech stocks for the past, 3 years.
Well, this is when the passive versus active debate, I think, really comes
exactly.
to life.
I think that's a really good statement because those are the dominant names in a lot of these indexes.
Sitting in the index, market cap weight, could get difficult if we hang out at these levels of Fed funds and beyond. Yields lower this morning. We're down 6 basis points on a 10-year, 358. Equity futures marching higher on the S&P by 1.6%. Yields down 6 basis points. Equities up. Dollar weaker. Euro dollar 98.90. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The oil market is looking to OPEC Plus to deliver a substantial cut in supply at its meeting on Wednesday. The price of West Texas Intermediate was around $84 a barrel after rising more than 5% on Monday. Currently, many nations in the cartel can't meet their current production quotas, so any agreement on a headline reduction in output would not lead to a drop in actual barrels. New York Fed President John Williams says the central bank still has a ways to go when it comes to raising interest rates. Speaking in Phoenix, Williams said interest rates are not at the level that would restrict economic growth. He said he expects real GDP to be close to flat this year and grow modestly in 2023. In Florida, the death toll from Hurricane Ian has now risen to at least 68 people. And according to modeler Verisk, insured losses are now estimated to be as much as $57 billion. President Biden heads to Florida Wednesday for a first-hand look. Samsung Electronics has announced an aggressive 5-year plan to lure U.S. chip buyers with more advanced technology. The company's chip contract manufacturing unit is looking to triple its revenue by 2027. Samsung is the world's largest chip maker by revenue, but it's playing catch-up with Taiwan Semiconductor when it comes to manufacturing. ARK Investment Management's Cathie Wood bought Tesla shares as they plunged the most in 4 months. Funds backed by Wood's firm bought more than 132,000 shares of Tesla on Monday. The stock was down more than 8%. This is Wood's second purchase in Tesla in 2022 after a year of selling down her stake. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The determinant of what happens to cable over the rest of this year is more than anything else going to be what happens to the dollar broadly, but what happens to euro dollar. If it's a cold winter, the euro and the pound are both going to suffer from concerns about blackouts. If we escalate the war in Ukraine, that makes things worse. If that quietens down, it gets a little bit better. But those are the drivers of sterling.
Kit Jukes of SocGen. A little bit earlier on, we're looking at a weaker dollar this morning, that's for sure. Yields lower, equities up. Let's look at this rally on the S&P 500, up another 1.6%. Equities up by 60 points on the S&P 500. In the bond market, yields lower by 5 basis points to 358.54. Dollar is weaker, euro stronger, 98.88. Take a look at sterling. The pound's stronger for a 6th straight session. And I can tell you from the lows of last week, 103.50, to the highs of this morning, which were 114.29, that is a 10% move in a week off the lows of last week. Massive move, Tom.
It's a massive move, and the big figures is like a 1 stick, and it depends where the decimal is, but a 10 big figure move is important. And of course, that wraps around to the politics, which Lizzie Burden is covering. Jordan Rochester would probably get on me. Birmingham?
I
did okay.
And Jordan's a hometown boy from Birmingham, yeah.
Jordan Rochester joins us now from Birmingham right now, G10FX strategy at Nomura. Jordan, I want to go to the news of the day, which is the Bank of Australia blinked. There's no question about that. Maybe it's a new trend, maybe it's not. If the banks start blinking like they did in Canberra, is that?
Canberra.
And Canberra, what does that mean for foreign exchange? What does that mean for your call on the dollar?
I think that's everything, Tom. Are we going to have more central banks blink? When it comes to the RBA, it stands out as one of the central banks with a mortgage market where most mortgages are variable, they're floating. So they do react to what's happening in rates markets today, in those housing markets for everybody, not just the marginal house purchaser. Where in the US with 10-year, 30-year fixes, in the UK with 2 and 5, in Europe with 10-year fixes, the impact of these rate hikes comes through with a different lag. In the UK, it's faster. In the US, it's much slower. And of course, the marginal buyer sets the price. So even in the US, your last guest was talking about the slowdown in house prices. But I think when it comes to the Fed, when it comes to other central banks, they're still going to be looking at inflation nowhere near their targets. But what's going on right now in markets is people are asking the question, are we going to listen to what the Bank of England experienced last week? Will the Fed, will the ECB think twice about what they're doing just in case we have a financial contagion risk that's building up with rates moving as quickly as they are? So I think right now it's all about mood music rather than actual action from anyone like the Fed or the ECB. I think central banks will still be hawkish. Inflation will still be stronger than they want. But right now we're in that sort of quiet space where we're all thinking, is the UK and is the RBA, are they both canary in the coal mine sort of situation?
Jordan, I sense you're skeptical. So are you fading this move? Is that what you're recommending to clients?
I mean, you mentioned a 10% move, and rule 101, and I kind of broke that, is don't chase flash crashes. And basically that's what we had in sterling after the mini budget. Huge moves, 5% moves lower. Typically, when you have that, everybody gets very convinced it's the right trade, becomes very consensus, and then policymakers react, and then you have mean reversion on that reaction. And that's what's happened. But in the UK's case, the reaction's been really timid. So just reducing the top rate tax from the 45 pence tax costs nothing, really. It's £2 billion. We're talking 100 billion for the energy package overall over its lifetime. So this 2 billion is a rounding error for the for fiscal sustainability. So for me, this is all about mood music. The UK is showing that perhaps they're not going to be as zealous when it comes to fiscal policy making. But if you take the facts as they are, everything's the same apart from that £2 billion of spending. So I am skeptical, John. And I also think core inflation in the US will remain stickier than what all of our leading indicators for headline inflation signals. Because commodity prices are softer, everyone says peak inflation. I agree with that. But core inflation will be stronger than you think, because look at job openings in the US. They're just ridiculously high, and they're not falling enough to say that we're having a weaker labor market. So this all feeds into the Fed not being happy where things are. And this softness in US yields, I don't think it will last.
So, Jordan, we were talking to Tom Tsouras of Strategist, a Baird company, earlier, and he was talking about how the price action that you've seen in 10-year treasuries and 2-year treasuries indicates stability, indicates price discovery in a way that we have not seen in years. Is the same true for your FX market, with the pound rallying 10% off of an incredible swoon?
I think most of that is poor liquidity, positioning in sterling being very one way. And then we had the rebalancing of month end. And we've got to remember as well, this pension situation meant that the amount of flows going through in the UK were huge. So it's kind of hard to say that, is this a fundamental price discovery that's going on? Or is this just everybody being one way and pensions being bailed out by the Bank of England's QE program, which comes to an end in less than 2 weeks? So we have to watch out for that cliff edge. What happens to the UK rates market once that QE program comes to an end? I think price discovery is still in effect. The US has everything the world needs. It has oil, it has LNG exports. The Europeans don't have either of those things. And a key difference, when they imported that natural gas from Russia, it was priced in euros. Not anymore. It's in LNG, it's in dollars. So there's a fundamental terms of trade shift that points to euro being at 90 cents by the end of this year.
Jordan, let me make clear, and I'm not trying to sell Nomura on this, but when the LDI scandal was breaking, I used a Nomura research report from 2018. Jordan, it was scary accurate about what the mess would be in the British pension market. Jordan, where's the trade opportunity right now? I mean, where's the big figure opportunity right now, everything considered?
I think where we are today, I think we've got this dollar softness thanks to lower US yields. It's backed up by mood music, the ISM being weaker, potential for China having this marathon and masks being taken off for that marathon. All kind of mood music stuff, not fundamental game changers. We've got NFP coming up on Friday. I suspect we'll have a strong average hourly earnings number. I think the jobs data will still hold up the growth on that side. So I think folks will be surprised, again, by US jobs not slowing down as they expect from all the growth signals we have. And then we've got CPI the week after. So I think really the trade is to fade this dollar weakness. It looks like everything we saw in May, it looks like what we saw in August. We had these kind of big drawdowns in the long dollar trade, but the trend is still there. So euro to 90, cable to parity and below.
Jordan, can you just congratulate Tom for saying Birmingham and not Birmingham?
I'm working.
We've been working on this, Jordan.
Working on it.
Next is the Brummie accent, so if he can say,
Yeah.
"You're right, mate,"
There
he'll
we
be.
go. Can you do that,
he'll be-
TK?
I want to go up to
You've
the
got
Plough and Harborne and have a true full English.
that
The full
was-
English up there is different.
That was an
than down in
authentic
London.
Brummie accent you
It
got
was.
just
It's
then.
very authentic.
From Jordan Rochester of Nomura.
It's a real
Jordan, thank you. We're in trouble with the Aussies.
Tom's wrong. Let's
can we
cut
clean
to the
this up?
chase.
Can we tidy this up a little bit? I'm not sure how we even got to this.
Me?
Canberra is the capital of Australia, right? But the RBA's in Sydney. Okay? We've
Yeah.
done that now.
Yeah, we've done this. I mean, this started out with Bloomberg on the economy decades ago. The thing is so fast what we're doing that we make errors constantly. Lisa's never made an error.
Never does.
But you make errors and you correct them. That's all.
The Brits are writing in, is Birmingham like Maryland?
No, I like no, don't correct that ever. No.
It's different.
By the way, I'm going to go home.
Maryland.
I'm going to go home and tell my kids I never make mistakes.
I feel like
I pronounce everything perfectly.
You don't.
When John says Maryland, it feels like Downton Abbey. That's
Maryland. Maryland.
It's a very merry land.
Maryland.
Isn't it an improvement? That's
the
better.
Orioles had a great year. It's a merry land.
Inflation is still stubbornly high.
Once inflation comes down, not only in the U.S., but also abroad, where you're going to see basically a bit of a relief rally.
I think the economy actually shows resilience here.
Getting those earnings expectations down is something that we really need to see.
I see earnings going sideways. I think we're already in a recession. It's just a growth recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. We are together in New York on radio and television. Thank you for joining. With a lift to the market, John, do we look to Sydney, Australia for a lift? Futures up 62.
You're calling it a blink. They go 25 basis points. The
Instead
market
of 50.
was looking for 50. I get it. That plays into the broader story this morning of peak yields, peak dollar, peak Fed, peak volatility. Take your pick, Tom. We're doing that again.
And we're on there in an important conversation in this hour. We'll talk to Citigroup about their linkage of the jobs report Friday into what this Fed does forward.
Bad news is good news. Bramo, that's what we're hearing from Citi this morning.
Yes.
Basically what they're saying is bad news this Friday could be seen as good news for this market.
And how much is what we saw yesterday with the ISM data that came in a bit softer, actually giving some wind to what we're seeing in the markets, which is a reversal, this idea that perhaps we have enough ammunition to talk about some sort of weakening. And do you have accelerated moves? And Tom, I wonder if this is the case, if you're seeing basically outstrip moves because of a lack of liquidity and positioning where people are just basically taking a pause.
Well, we're not taking a pause. In the last 2 days, it's been sobering. But what you mentioned, John, earlier, the Ray Dalio capitulation, cash, not trash. I get it. Okay, great. But is this a true capitulation? I don't see that.
I don't think it is just yet, but we have seen a repricing, and the repricing is important. We've taken the peak Fed funds rate down from about 470 back down to about 440. I think 30 basis points is significant, and that's feeding into the overall enthusiasm in equities. I'd go back to something Mohamed Al-Arian said, though. If you're pivoting, pausing at the Fed for reasons like financial instability or recession risk, or the fact that we're in a recession right now, is that bullish? And I think that's a question we've got to discuss.
Lisa, quickly here, Tom Satoris of Strategist, I thought was brilliant on high yield. What's high yield dynamic signaling? He's pretty grim on the spread market of troubled debt.
There is this question about whether we see a default cycle like what we have before. And we were talking earlier, John, you brought this up. Have we readjusted to the idea of, let's say, 10-year yields remain around this 4% level
we'll take 10
for a longer percent? Well, you get 10% when you look at high yield bonds. I mean, that's where you end up.
Sure.
And how much have we really priced in the potential weakness, what that does to rearrange the rest of markets that have been financed on 0% rates? This is the unknown.
I'm going to go back to supported. Let's go to the data, John, because we've got Jeff Yu coming up, important a guest. I'm going to look at the real yield, 1.37%, sitting on support, going nicely back to the third week of September.
I'm looking at stocks up and away on the equity market, on the S&P 500 up by 1.7%, up 63 points. We've talked about equities up, yields lower, down 5 basis points on a 10-year, 358.74 this morning. Last week through 4%, and that's the turnaround in this bond market. We saw 4 on 10s, we now see 360. You saw 435 on 2s, and you now see something closer to 4%. And off the back of that, you've got a weaker dollar. Euro dollar 98.91, that currency pair, Tom, firmer by 6 or 0.7%.
The real value here, folks, is what we say in commercial break. I wish all of you could feed into the conversation with our guests as we prepare for the hour. Jeffrey Yu joins right now, Senior Strategist, BNY Mellon. Jeff, I'm learning every step of the way, and I want to talk about the dynamics of every nation and every political leader as they try to amend policy for the elite. Now, I've learned that the elite are the prawn sandwich brigade. And there's no question about that, going back to Truss in the United Kingdom. Are we making policy now for the elite that will crush the middle class?
You are allowing Manchester United fans to reminisce about the old days, really. At least they were winning when the prawn sandwich brigade was coming through. But that is the perception right now. And we have to just acknowledge that politicians, when you're setting policy, you have to be extremely cautious about the distributional effects of this. Even before the Chancellor launched his supposedly mini budget, we were concerned about the distributional aspects of the energy support plan. Why are you subsidising high-income households to the same level as lower income households? And now it's coming out into play, and this will really generate a lot more volatility in policy making and translate into market issues further down the line.
Jeff, from your position, are financial stability concerns bigger than inflation concerns for these policymakers?
Sitting from London, no. I think this time around, in respect to the pension issue with the LDI issue, you've seen the purchase volumes at the end of the day. It was basically a precautionary step, warnings being sounded, and basically the Bank of England said, we will be on the other side of this. As I mentioned last week, right, it's whatever it takes when it comes to financial stability, and I think markets get that. But at this point, it really is back to inflation. Inflation's the number one priority. Until inflation is under control, monetary policy will still have to chase inflation, trying to cap it, and that's where financial conditions are tight, and you can get accidents as well. So there can be no rest for financial stability until we tame the inflation side of things as well. The two are intertwined.
Jeff, do you think that we've overplayed financial stability concerns based on what happened in the UK and based on the fear of how much liquidity is being withdrawn from the system?
Right. I don't think we've overplayed it per se, and there are individual structural issues behind the LDI framework within the UK. But to automatically assume that what happened in the UK is going to cause the Treasury market to crack or the fissures elsewhere, I think that side of it was a bit overdone, especially the interpretation that the next phase is, oh my God, central bankers, they've overdone it. It's going to be financial stability issues everywhere. They're going to abandon inflation targeting. That side of it clearly has been overplayed.
But is there some truth to this idea that perhaps central bankers are rethinking the pace in which they want to raise rates, that perhaps it's not necessarily the target that's changing, but how long they are willing to execute these rate hikes over, and that the RBA is a good example of that they're actually going much slower, but they're not necessarily pulling back wholesale from a tightening cycle?
So it really depends on which specific side of the economy in a financial stability context that you want to manage. Take Australia, for example. I think it's a terrible example for the rest of the market because their cycle is not exactly linked to where the US is. It's much more linked to China and the like. And also Australia, they've been highlighting their own domestic household leverage, one of the highest within the G10. So that side of things would decelerate far quicker. And crucially, I think markets are missing this. The RBA have clearly cited beforehand they wanted to front load things as aggressively as possible. So it shouldn't become too much of a surprise that they will hit peak yields. They will hit terminal sooner than the rest of the market as well. Basically, just want to say to the market, don't extrapolate too much from what the RBA did overnight.
So, Jeff, let's set up the Federal Reserve in the next month or so. Another 75?
That absolutely has to be the market base case until they really start to see proper fissures within the Treasury market or elsewhere, even anything remotely close to the gilt market. What happens to the gilt market? We are not seeing that at this point. But of course, they probably will need to acknowledge that financial stability is something that they are monitoring. But let's put it this way. We are not where we were in 2007, 2008. Europe is not where it was in 2011, 2012. There are so many tools at their disposal. They can handle this, and they will be on the other side of financial stability. And based on the reaction in the gilt market so far, I think markets believe them.
Jeff, where does that leave QT? How sustainable is that effort?
So QT is sustainable as well, especially in the US, where they have a better handle on the inflation versus financial stability argument. In the UK, we saw the initial fissures, but the BOE have been clear to stress that they're slowing QT to preserve financial stability, to monitor it. Once they know where the risks are, they've covered their bases, then they're already, I think they will be able to resume the QT framework as well, because that is a monetary policy operation. They want to separate that from financial stability risk. But if there's the first sign that the monetary policy operation will begin to impact financial stability, there can be a new argument, there can be a new discussion over that. But until there's decisive proof of it, I think they're going to continue with QT as well, because that's necessary to slow inflation.
That's the US story. What about in Europe? Could you see perhaps a reversal, not only of QT, but an engagement of effectively quantitative easing, as Freya Beamish was saying earlier on this show?
Right. So I think for Europe, again, idiosyncratic risks do matter, but they have OMT, they have the TPI as well to manage any spread widening, the fragmentation risk. So they have that side of it covered as well. It hasn't really been an issue over the past few weeks or so. It's there. I don't think markets want to test it. QT will take place in Europe when the market is ready for that, but I just don't think they're strong as consensus within the governing council right now on rate hikes, let alone QT. So that's where Europe is probably one step behind the rest of G10, and I think that's been reflected in euro-dollar as well. But with the latest inflation print, I think they need to accelerate.
Hey, Jeff, I've now got to explain what the prawn sandwich brigade is, so thank you very much for participating. Jeff Hughes,
nailed that.
BNY Mellon. Jeff understands this. He remembers as a Manchester United fan. Back in the days of Alex Ferguson, Sir Alex Ferguson, phenomenal, legendary manager of Manchester United Football Club, the atmosphere at Old Trafford, the stadium, was dreadful. And he would refer to those fans as the prawn sandwich brigade. The wealthier crew that turned up, unpacked their prawn sandwiches, nibbled away and didn't make too much noise. He wanted more noise, Tom.
Yeah.
More support in the stadium, a bigger atmosphere, and he didn't
We
get
have
one.
the same thing here. I mean, I'm hugely critical of the New York Yankees, and you see when they play, fabulous team, all the empty seats from the prawn sandwich
You
brigade
price out the real fans.
down the restaurant, and they're gone. I give Fenway very great credit for this, and that down fancy, you sit in the same chair essentially.
You know
as
what
up
drives
top.
me insane? Empty corporate seats.
Yes.
Drives me nuts.
Yeah.
See that at the US Open courtside.
Yeah.
It'll be empty around the boxes. People got free tickets and didn't show up.
I was looking down at that at the Open there when I went the other day.
I saw your seat.
So hold on a second. Prawn sandwich. What's the other side? What's the traditional? Is it
you
pie?
have a pie.
A
You have a
pie.
pie.
But no,
You have
but
a
if
pie.
you're a tourist,
Pie and a pint.
this is
Yeah,
important,
okay. Sorry,
folks.
you get a pint and a pie.
On radio, I'll try to do this. If you're a tourist like me, I don't know
And
what
it's
you're
pie
supposed to
with a
do.
knife and
I'm
fork.
eating it with a fork.
Even I knew that was not right.
And John Farrow's on the
That's
phone.
saying
He's
something.
seeing me on the camera. He's like, "What the hell are you doing?"
I wish I'd got a
It
picture
was
of
just
this.
so embarrassing.
On your
Pie
lap
with
like
a knife
this.
and fork.
You just show us that you grab it and you
just eat away.
Eat away.
We've started the Maryland thing as well.
Yeah.
Thank you to the Bloomberg subscriber who helped me with that. Maryland.
No,
And
say Maryland.
Thank you to someone else
John,
who said,
you'll lose your innocence.
I understand the state is so taken with John's pronunciation that December 1st they will officially change their name to Maryland for the holidays.
Good.
Maryland. That is wonderful.
I'll
Okay.
change that.
From New York. We upsetting anyone else this morning? A whole country?
Oh,
a state?
I have a couple.
What's left? You got a few more to go?
Sure.
Okay. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In the UK, Prime Minister Liz Truss says she hasn't decided yet whether welfare payments should be increased in line with inflation. And that's an issue that threatens to cause another fight with her disgruntled Conservative members of Parliament. In a radio interview, Truss said that pensioners would see their payment rise along with inflation, but she wouldn't commit to the same for other welfare recipients. In Ukraine, President Volodymyr Zelensky said that liberating settlements from Russian occupation is now the trend. His forces have pressed further into the eastern Donetsk region and seek gains in the south. Meanwhile, the Biden administration will announce another package of U.S. weapons within days. Tensions are increasing over Kim Jong-un's nuclear weapons program. For the first time in 5 years, North Korea filed a missile that flew over Japan. Now, that prompted a rare public safety warning from Tokyo. The missile splashed down in the Western Pacific, about 2,000 miles east of Japan. And if you're looking to get away for the holidays, book your travel flights now. The Wall Street Journal says already high prices will rise in the coming weeks. A recent search from travel site Kayak shows the average price for domestic travel during Thanksgiving week this year up 48% from the same time last year. And during Christmas, well, it's even worse, up 52%. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Evidently, the decision will come tomorrow. That should be, I think, a 1 million barrel a day cut. We've got about half of that probably Tom actually delivered, but it's still enough to tighten what's effectively a market imbalance in Q4. So any cut will effectively serve to raise price.
That argument is what's behind the rally in the crude market in the last 24 hours. That was Paul Sankey, the founder and lead analyst at Sankey Research. Crude right now on Brent at 1.5% to $90.20. On WTI up 1.2% to $84.65. That's the commodity market. Here's the story more broadly in the equity market and beyond. Equities up and away, up 1.7% on the S&P with yields lower. Treasuries firmer, 358.54 on a 10-year, down from 4% last week and down 5 basis points on a session. Talked about this a lot this morning, Tom. Dollar weakness, euro strength, 98.96, euro dollar, positive 0.7%.
Watching real yield 1.36%. If that cracks, that's important to me. We have not seen that yet. Right now is a joy. Pavel Molchanov is at Raymond James out of Duke Economics, and far more, he is someone who's put money where mouth is in great work in energy and sustainability for Raymond Jeffries, and also his work on charity. I would point out the Molchanov Sustainability Internship Program at the Royal Institute of International Affairs in London is something Pavel works on. Pavel, thank you so much for joining. I've got to turn to OPEC, which is maybe not sustainability, but there it is, OPEC Plus. You are heated. Watch what they do, not what they say. What is the distinction?
Easy for OPEC to announce a production cut. We've seen that, countless times for decades. The real test is implementation. So we know that Saudi Arabia tends to be disciplined, tends to fulfill their commitments. But many OPEC members, you can think about Venezuela, Angola, Nigeria, they do not tend to implement what they promise. The logic being, they need the money, lower income levels. So the burden of actual enforcement tends to fall on those core Persian Gulf members, particularly Saudi. Will they single-handedly carry this potentially million barrel a day production cut? We'll see. Right. It happened during the first days of the COVID crisis, spring of 2020. Saudi Arabia was amazingly disciplined at that point. But of course, now these are very different times.
Pavel, how much is demand actually declining versus the expectation that it will decline in the face of slower growth?
Well, to be clear, global oil demand is tracking to a significant up year, between 1% and 2% growth in 2022. Of course, there is still some post-COVID catch-up in that. The real question now is what will demand be next year? We think it will be up, perhaps not as much as, we would have said 6 months ago before all of the monetary tightening around the world, but it should be up. I will just remind, as by way of historical background, only 4 times in the past half century has global oil demand declined. So 2020, COVID. Before that, we have to go all the way back to the global financial crisis, and before that, to the early 1980s. So it's highly unusual for oil demand to shrink on a calendar year basis.
Given that, how much do oil prices stand to increase? If OPEC Plus does approve a million barrel production cut and you do see demand increasing, not decreasing next year, what is the effective resulting price of the barrel of oil?
Million barrels a day is 1% of global supply. We know from what's called elasticity in Econ 101 that on average, a 1% reduction in supply creates a 5% increase in prices, all else being equal. So we're talking about $5 a barrel extra. But let's remember, we have some other variables we need to think about in relation to the oil market, including, of course, the war and everything flowing out of that. Russian supply has already declined and will continue to decline.
Pavel, I want to go to your wheelhouse of sustainability. Is ESG forever altered by the war, by the moonshot and coal that we see, like in Australia? Newcastle coal really hasn't given it up. How does ESG adjust to the next decade?
the war has not changed the basic paradigm that ESG will be a source of pressure on fossil fuels, both in a fundamental sense and in an investing sense. So, for example, let's zoom in on Europe, which is in the middle of an energy crisis. Yes, there is a little bit of an uptick, maybe 2%, within the electricity mix of Europe in terms of coal consumption. But we're still talking about barely 11, 12% of Europe's electricity coming from coal this year. By 2030, that number will probably be mid-single digits. So the trajectory is heading in one direction. And coal is the biggest, sort of public enemy number one in a climate sense. And this is where a lot of divestments of major institutional investors are focused on. Not as much attention on oil and gas, but certainly those sectors are also out of favor from an decarbonization perspective.
Pavel, wonderful to get your thoughts this morning. Thank you. Just getting some headlines out of Europe. Pavel Molchanov there of Raymond James. Allow me to turn to those headlines. Olaf Scholz, the Chancellor of Germany, with a meeting with the Dutch Premier, Mr. Rutte, who we've spoken to over the years. Tom, good friend of this show. Scholz says Germany seeks a considerable reduction in energy prices. Now, I assume Lita is talking about this winter. Beyond this winter is the conversation we've tried to have over the last several months.
And what it takes to get those considerably lower prices, is it that 200 billion euro package that's causing quite a bit of consternation among European allies? And what does that mean for the rest of the bloc that can't afford that kind of support for their energy companies and their energy bills for the households?
This is the issue that Maria was getting at a little bit earlier this morning. Was she in Luxembourg? From Luxembourg, I believe. I can't keep up with Maria today.
Her hair wasn't blowing as much as usual.
That means she's indoors.
Yeah, exactly.
You said that, not me. Tom, this is the issue. I know.
I'd be so
I know.
out. Oh my word.
Let's move on. This is the issue in Europe right now, that package from Germany was so large. Who else can follow with anything like that in southern Europe?
No, that's the dominance of Germany. That was in one of the research notes this morning. Karl Weinberg, I think, had that, where Germany is just completely dominant. What I would note is what you mentioned a couple days ago. There's a difference between 9% in 10 or the Netherlands 11% inflation. Double-digit changes the dialogue.
The minister from UAE right now, OPEC Plus to take decision after reviewing the market outlook. We're all assuming that takes longer than 13 minutes this time around. From New York.
Get to the A block.
This is Bloomberg. A little bit of data out later in the United States for America. Factory orders, durable goods, capital goods, jolts, job openings, all coming out in about an hour and 30 minutes time. Going into that, equity futures elevated, pushing higher, adding some more weight to the benchmarks here in the United States. Futures up by 1.6% on the S&P, building on the gains of yesterday, the biggest one-day gain on the S&P, biggest one-day pop since July. Yields lower yesterday, aggressively so, by around about 18 basis points on a 10-year. Down another 3 this morning, Lisa, 360.52 on a 10-year.
So here's the issue. Is this just basically readjusting with pensions and other investors seeing some value here in duration heading into a downturn? Or is this something that is a head fake, right? Is this basically people covering their shorts, reassessing before the next leg of whatever Fed communication we're
Governor Lowe's the lead indicator for global central banks, didn't you know?
Is it so?
And the RBA.
Yeah, the RBA.
Going 25 instead of 50. Everybody getting on board with that because it speaks to the price action we've seen in the last day or so. Yields are so much lower, Tom, now compared to where they were a week ago.
A week ago.
On a 2-year 435 and now at 4.
And again, as you mentioned, the shift is what's important here. We've seen a shift in yields, not the dynamics of the yield curve so much. 10-year real yield 1.38%. What I would note, John, is this is where the pros focus on the fixed income market versus the other markets to get signals.
I want to turn to the work of Citigroup earlier this morning.
Please.
Andrew Hollenhorst, Veronica Clark on the team. This is what they had to say. We continue to see fundamental economic risks as balanced toward higher rates and lower risk asset prices. This was just for you, TK. I asked Andrew to put it in there. Friday jobs report is growing in importance. A softer reading would continue the, quote, bad news is good news for equities narrative. That's the story of the moment.
There it is from Citigroup in their update. We're going to see a lot of that migrating to Wednesday, Thursday. I got my prawn sandwich over here. I'm going to have my Tang. Leave me alone. Veronica Clark joins us right now, global markets economist at Citigroup, and we are fair and balanced. As we just had a gentleman from Duke on, that's a small school, 8 miles from UNC. We speak to Chapel Hill's Veronica Clark this morning. Veronica, okay, so we get a good jobs report, well over 200,000, maybe 300,000 jobs. We are so far distant from a non-farm payrolls, which is what the Fed desires. Do we get there abruptly?
Yeah. I don't think we get there just yet, but we will be watching for signs, later this year and into next year that you could start to see that, more consistent slowing in monthly job figures. We're expecting a 265K on Friday, which is still very strong, but slowing. But as we're getting into mid next year, I think that's really when we see the negative prints that could start to pop up, and that's really the loosening that the Fed wants to see.
Are wage dynamics in the wage part of the Friday jobs report signaling wage inflation?
Yeah, we're a bit higher than consensus on average hourly earnings, so we're expecting a 0.4% month-on-month increase. Also expecting the unemployment rate to fall to 3.6%. Both of those together are really what the Fed doesn't want to see, and that is still a really tight labor market. I think really what the Fed is looking for in all the wage data, all the jobs data, all the inflation data is signs of a loosening labor market, and I don't think we get that quite yet.
Veronica, we were speaking with Tom Porcelli in the past week or so, and we were speaking about this on the show earlier. He was saying that there's been a structural change in the labor market and that we may not see the weakening in the jobs, in the labor picture, just because that people have had such a hard time hiring enough workers during the pandemic and afterwards. Do you think there's credence to this?
Yeah, absolutely. I think if you look at the number of people who left the labor force during the pandemic, and then you look at the overshoot of job openings, that are around 11 million versus 7 million before the pandemic, that's about the 4 million people who left, and it doesn't seem like that demand is going away. So the fact that job openings are still so high, and we'll get that data actually later this morning, it could just take a while, to see this slowing in hiring.
So then how should it be looked at in terms of understanding the weakening and the pace of the weakening in the economy? I mean, are you sympathetic to the view that perhaps the Fed is looking at a backward-looking indicator, as John has mentioned, in order to make forward-looking moves at a time when the economy is moving faster than we've seen it move in decades?
Yeah, that's very fair. These monthly job figures that we get are some of the last usually to turn. They are more lagging indicators. But I think if you look at all the labor market data, as a whole, something like initial jobless claims, which are still very low, those tend to be a more leading indicator, and it's still also pointing towards a really tight, strong labor market.
What is the undershoot, the blink by the Reserve Bank of Australia? What does that signal to Citigroup?
Yeah, I mean, I'm not an Australian economist, of course, at all. But I think markets in general are looking for this sign that maybe central banks are, reaching the highest level of rates that they can get. Maybe we're at peak pricing. But for the Fed, at least, I would really caution that, we've been here before. We've been looking for this peak before, and it really hasn't happened. The Fed is just going to stay focused on domestic data, labor market data, inflation, and we really haven't seen any change there. Away
from labor market data, what data matters to determine a Powell peak?
I mean, definitely inflation. Inflation, of course, is still the most important. And really, since the September meeting, we've had really just one data point for that. That was PCE inflation last week. And if anything, it looks like the Fed's forecast in September for 4.5% PCE, core PCE at the end of this year are still too low. And of course, we'll get CPI next week. We'll be looking at the details of that. You could see weaker goods prices. But if you still see really strong services, that's telling you that underlying inflationary pressures are still really high.
Let's look out past this Friday when we get non-farm payrolls, which may be increasing in import, and beyond to earnings. And we've seen some preliminary earnings reports that highlight increasing weakness in the pace at which companies are revamping their expectations. How closely are you watching that? What are you looking for in these earnings reports to perhaps reassess how either deep the downturn is or what the Fed response could be?
Yeah, I mean, we are certainly looking at, business sentiment. Of course, earnings is part of that. Because how the Fed sees, policy impacting the real economy, I think, is through businesses seeing, earnings that are weaker, equity prices that are lower, and them saying, oh, I need to cut costs, I need to lay off people, I need to not hire as many. And that's eventually, of course, what causes the loosening in the labor market that brings inflation lower. I think could just be a longer lag between when we see that worsening sentiment and when we actually see it in the hard economic data.
This lag, people have been talking about it. Do you think the response to the lag is to go slower? This is one of the key debates among Fed officials, to move slower, but the same level as where there's targeting of 4.5% plus or minus a little bit? Or do you think that this is something that they're going to ignore? They're going to just keep going at the pace they're doing front load and then stop when they get to that 4.5 and figure out what the damage is?
Yeah, it is a bit interesting. I think that the Fed, seems to signal even more 75s. We're expecting another 75 basis point hike for November. It would make sense to me that maybe you slow down and you go consistent 50s. Maybe, you give yourself time to see that, weakening in inflation, weakening in the labor market show up. But for now, it seems that they're on this front loading path. And we do think rates can get to, 4.5 to 4.75 and stay there. But the risk would maybe still be that they go even higher.
Veronica, unfair question. When is good news just good news?
Maybe at the end of 2023 when we're hopefully coming out of a recession.
Dear me, we've got to wait that long, TK. For good news to be good news, end of 23.
While you were doing this, I was looking at the WIRP function. We're just all wrapped. The prisoner's dilemma, 4 boxes, good news,
Sure.
Good news, bad news, whatever. Bad news. It's Alarian is correct. This is busted game theory. Look at the fundamentals. And I'm sorry, there's some recessive statistics out there, starting with China. To me, that's way more important than the financialization of our dialogue.
Conceptually, though, it does make sense to have that argument. And Veronica, fantastic to catch up with you as always. Veronica Clark there over at Citi on the team with Andrew Hollenhorst and company. Conceptually, it makes sense, right? That good news becomes good news once you've seen your way through this recession and you want to see the better data and the Fed's got out of the way.
When it becomes the point where the Fed is not the main driver of price action.
And it is right now.
Right. It still is. And that is the real main point here. The Fed is still driving a lot of the activity at a time when they want to pull back. They want to not be the sort of puppet master behind the scenes here, which they have been for decades.
Job openings a little bit later. Is that the key data point for you today?
Absolutely.
At 10 a.m. Why?
Absolutely, because they're looking at the labor market. They said that they're not going to take their foot off the accelerator until they see jobs really become less prevalent, until they see the loosening in that market. And you're not seeing it certainly in the initial jobless claims. So to me, that is the key data point of the day.
That's the hope, Tom, that we can get job openings to come down without smashing the labour market up too much and causing a big recession.
I'm with selected people. Mike McKee tells me...
You're not alone.
Mike McKee tells me JOLTS really matters. That's the reason I'll be blunt. If McKee says it matters, it matters. But the bottom line, I don't care. The bottom line for me is simple. We're arguing about the employment of people in America. I think it's just
Tom,
a
it's
distraction.
Absurd.
It's absurd.
No, I actually think it's worse than that. I think it's worse than that. This is going to get really difficult for this Fed, and it's something we haven't talked about for at least a week. If unemployment starts to go in the wrong direction over a long period of time, and this Fed's still hiking interest rates, then the communication of this Fed, I think, just gets harder. With Senator Warren, I imagine Senator Warren finds a lot more company going into the midterms if this labour market is cracking over the next month. I imagine she finds a lot more company.
And it will be bipartisan as the job losses start to mount, because nobody wants to see people lose their jobs. And yet, how do you achieve some normalcy to inflation? It puts the Fed between a rock and a hard place. Communication is going to be fraught.
TK?
I think there's an underestimation of the technology overlay. There's an underestimation of the entrepreneurial spirit of America. I get it. It's massive systemic uncertainty right now, but to focus on financialization of it like it's a parlor game just has no service.
Do you think companies will adapt?
I think companies will adapt with a vengeance. With a vengeance.
This Fed will be data dependent as well.
I mean, the most
will
important,
be data dependent, and companies will adapt.
The most important thing we did today was Abramowicz on the wall with the equity model of big companies adapting.
Where's that pen come from? that you're pointing at the camera? Where's that come from?
He just keeps it there.
Is that your new...
as a pointer?
No, I've had this. It's just we're all together.
That's new. That's new.
A laser.
Come in with a stick tomorrow.
No, I'm going to get
Futures
one of those laser
up.
guns.
1.5. Yeah,
the laser thing.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The oil market is looking to OPEC Plus to deliver a substantial cut in supply at its meeting on Wednesday. The price of West Texas Intermediate was around $84 a barrel after rising more than 5% on Monday. Currently, many nations in the cartel can't meet their current production quotas, so any agreement on a headline reduction in output would not lead to a drop in actual barrels. Bloomberg's learned that the UK sees the prospect of a deal with the EU on Northern Ireland's trade arrangement within months. People familiar with the matter tell us the government has softened its approach, and that's led to a significant shift in the dynamic over the past month. That could finally draw a line under Brexit negotiations more than 6 years after the UK voted to leave the EU. In Florida, the death toll from Hurricane Ian has now risen to at least 68 people. And according to modeler Verisk, insured losses are now estimated to be as much as $57 billion. President Biden heads to Florida Wednesday for a first-hand look. Samsung Electronics has announced an aggressive 5-year plan to lure U.S. chip buyers with more advanced technology. The company's chip contract manufacturing unit is looking to triple its revenue by 2027. Samsung is the world's largest chip maker by revenue, but it's playing catch-up with Taiwan Semiconductor when it comes to manufacturing. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
I'm totally stumped, mystified, surprised that Fed officials don't seem to acknowledge that just focusing on the Fed funds rate as part of the monetary tightening cycle is a mistake when you also have QT2 and you have a soaring dollar. I think they got one more rate hike coming in November, and that'll be it, because the financial stability issue will pop up as primary concern.
They listened in Sydney. RBA blinks this morning. Big news about 12 hours ago, maybe off of Edward Yardeni. Dr. Yardeni there with a really controversial comment about a Fed that has, quote, one more move left. Of course, part of the parlor game. We welcome all of you on radio, on television. Lisa Abramowicz and Tom Keene. Mr. Ferro back in makeup for the next hour. Always good and important for him. What do you think of Dr. Yardeni's effort there?
I can say I don't think that the RBA only raised rates by 25 basis points because of what Ed Yardeni said on the show yesterday. However, I mean, I'm just, I think, though, that there is this issue of a very different market, and drawing the distinction between Australia and, say, the United States is going to be important for discerning the tea leaves for the Federal Reserve versus the RBA.
And part of that is what we see in the fixed income market. Everybody has a lesson where they learn fixed income really matters. For me, years ago, it was when Amazon blew up, and Lehman Brothers was way out front on the credit dynamics of Amazon versus all the buy-only equity certitude that was out there. What does the bond market say right now about the ballet into fourth quarter?
Well, there's a resetting right now as you are getting a real demand into, particularly the long end, into treasuries that are 10 years out, 30 years out. How much this really is any indication, though, it goes back to something that Tom Tsouras was saying, that this actually is giving him some confidence in the reliability of this market, not because you're going to see some constancy or lack of volatility, but because you're seeing real price discovery for the first time for decades.
Maybe the zombiness drifts away in the bond market. Look for Satoris' interview out on Bloomberg Digital right now, and this is a joy. Paul Davies is somebody, he was at the Journal, the FT, and I was like, oh, damn, I got to read this. He's now with Bloomberg Opinion, and we are honored by that. Paul Davies joins us this morning. Paul, the litmus paper on CSGN is over to Bear and over to Lehman. Clearly not accurate, clearly off the mark. How off the mark is it? What's the state of Credit Suisse versus our collective memories?
Well, okay, so one of the simplest things I did to kind of think about this today was look at the liabilities, the kind of the funding of Credit Suisse in 2007, Credit Suisse today, and Lehman Brothers in 2007. And that kind of helps to show you just how much things have changed. So, for example, back in 2007, Credit Suisse's sort of deposits and long-term debts was about 36% of its funding, and now it's about 75%. And if you look at Lehman Brothers, totally the other way around, short-term funding and trading liabilities, securities refinancing, all of that stuff, that was about 76% of their balance sheet at the time. So it's, just in that very, forget all of the liquidity coverage ratios and net stable funding ratios and CET1 ratios and all of this modern stuff, just in the simplest sense, the funding structure of banks today is completely different to how it was back in 2007, 2008.
So, Paul, perhaps that means that Credit Suisse isn't poised for some sort of imminent swoon, but certainly the price valuation that we're getting with respect to the stock moves and in the CDS market are a lack of faith that makes it much more difficult for Credit Suisse to raise money effectively without further reducing their valuation. How much is this pushing Credit Suisse into some sort of acquisition, sale, something that means that Credit Suisse will no longer be Credit Suisse as we know it now?
Well, their preferred, strategy to reshape the bank from the beginning, I think, has been to, either find an injection of third-party capital, some extra money just to help fund the securitized products business, which they think might be more attractive to somebody else, to a different owner, or to find sort of assets to sell. And, we've had stories about how they might sell some of the wealth businesses in Latin America, for example. I don't think even when they started looking at this, they thought that capital raising was one of their first options, going straight to the equity market. And as time has gone on and as people thought about the fact that they might want to raise some capital, which, at the end of the day is to speed up the restructuring. It's not to kind of solve problems that they have today. It's to allow them to restructure faster. As people have thought about the fact that that might happen, that's just hurt the shares more. And they're now like, 20% of book value. Yeah. They're just in no position really to do it. They would have to be really desperate to come to the market at this point.
We were talking just now about the distinction between Australia's central bank and the U.S. central bank. What is the distinction between Credit Suisse and European banking at large? This question of, is it just an idiosyncratic moment, or is it representative of further problems in the face of a tumultuous market and economy?
Well, I don't know. That's a tricky question. I guess the main difference between, you think of like the big German banks where, the returns of the kind of ordinary lending and retail business that they do at home have consistently been very, very low for a very long time. And that's always made things like Deutsche Bank and Commerzbank much, much harder to turn around and much, much harder for investors to see as something very promising in the future. Whereas,
I've grayed Paul at Davos asking this question to banker types. When do the European banks merge cross-border? Do you see any cultural newness to the idea finally we'll get like what we saw with Fortis a million years ago?
I guess that deal was born, out of a different time. The problem is that, European banking markets just don't work in a fluid way. Right. It's not really a single market. It's very, very difficult to put a bunch of retail banks together across Europe and turn them into a single bank that has real synergies and real savings and really kind of boosts the returns that you can get from it.
Paul, thank you so much. Paul Davies, writing for Bloomberg Opinion. Spectacular essay on Credit Suisse. He says, calm down, everyone. Mr. Davies, of course, with decades of experience there as well. Lisa, we stagger to 10 a.m. Let us review JOLTS, which is a real measurement two ways of the jobs market. Unlike claims, it's a two-way study.
How much are companies posting openings? How much they need employees? And what we've seen anecdotally is that a lot of companies are still hiring. Some are freezing, right? You see that from Facebook's parent company, Meta. They plan to be a smaller company next year. You hear this from a lot of companies, but on the peripheries, you're still getting a lot of postings. And I go back to July. We actually saw it increase on a month-over-month basis.
With the pandemic and with the shock of the fiscal impulse and the savings rate, which is depleted, I get that and all that, it's just absolutely original labor analysis into Friday's jobs report. This is completely original from anything I've seen.
There have been a lot of people who've retired. There are a lot of people who are out of work because of long COVID. The uncertainties, the vagaries that are hitting all of these companies, having to be translated into some kind of policy by the Fed is not an easy task.
Are the retirees going to go back to work now that COVID drifts away?
I mean, a lot of people retired, so we'll see whether they come back in. I mean, this is the whole question. If they do, this is what they're hoping for that perfect landing, right? This is the soft landing, sweet spot, the Goldilocks scenario. They come back in, lower the wage increases, and we get back to normal.
I suggest that the retirees possibly will come back to work for any number of reasons. Not that I know about that, but futures up 58, Dow futures up 378. Put it together 2 days in a row. Up in a way. Please stay with us on radio and television. This is Bloomberg.